IT, are we live streaming? Part of that's been corrected now. We may need to restart. We may need to restart. I don't know. Let's see where.
Yeah, I would suggest
think
restarting.
I would agree.
Our IT, are we good to go now?
We are good to go. Thank you.
All right, thank you. Good morning and welcome to the Evergy Capital Expenditure Work Study. This work study is being conducted under and pursuant to docket number 19-KCPE-096-CPL, which is a capital plan compliance docket. And at this time, I am calling this work study to order. I'm Dwight Keene. I'm chair of the Kansas Corporation Commission. I'm joined by fellow commissioners Susan Duffy and Andrew French. Commissioner Duffy, do you wish to make any opening comments?
Yes, thank you. Good morning, everyone. I'm looking forward to and appreciate this opportunity to hear more from Evergy and others today about the capital expenditures. Thank you.
Thank you. Commissioner French, any opening comments?
Yes, just very briefly. I also appreciate this opportunity, and I'm glad we've taken this step to ask for more information. And I'm glad that Evergy has been willing to come forward and provide us with information and explanation of their plans. From my perspective, I understand and appreciate that public utility service is a very highly capital intensive service, and a large amount of investment is needed. We are never in a situation where we don't want any investment. We need investment. It's all about understanding the level of investment, making sure the optimal investments are made, and understanding the pace of investment. And I think that's what we're here today to find out about, and I appreciate the opportunity. So thank you.
Thank you, Commissioner French. We want to thank all of those who are joining us on YouTube for attending this public workshop, which is intended to provide Evergy with the opportunity to explain the necessity and impact of its capital spending proposals. The Commission believes that this work study is an important opportunity for both the Commission and the public to learn more about Evergy's proposed capital spending. We look forward to learning more about Evergy's rationale for its increased capital expenditures and having the opportunity to ask questions. We're conducting this work study by Zoom and broadcasting to the public on YouTube. Please bear with us if you or we should experience any technical glitches. Depending upon the length of the workshop, we plan to take a lunch break as well as periodic 5 to 10 minute breaks as needed. There may be some confidential information discussed today. To the extent possible, we will save consideration of that information until the end of the work study. Pursuant to KSA 75-4319B4 of the Kansas Open Meetings Act, it allows the Commission to conduct a closed session to discuss data relating to financial affairs or trade secrets of corporations if there is confidential information to be discussed. If so, the Commission will go into a closed meeting. Individuals affiliated with the interveners who have signed and submitted non-disclosure agreements are permitted to attend the closed session. Members of the general public viewing the live stream on our YouTube channel will not be able to participate in any closed session. We will begin this work study with a presentation for Evergy. The Evergy presenters will be David Campbell, President and Chief Executive Officer, Kayla Messamore, Vice President, Strategy, Long-Term Planning, Bruce Aiken, Vice President, Transmission and Distribution, Steve Fish, Senior Director, Large TS Construction, and Chuck Casely, Senior Vice President, Public Affairs and Chief Consumer Officer. During Evergy's presentation, we will break for questions after PowerPoint slide 26, break again after PowerPoint slide 36, and then allow for further questions at the conclusion of Evergy's presentation. In our order scheduling this workshop, we outlined a format that would begin with commissioner questions, followed by CURB questions, followed by KCC staff questions. Upon further reflection, we revised the format to have the KCC staff questions first, followed by CURB, and then finally the commissioner questions. As I suggested, we may go into closed session to discuss confidential information as necessary. With all of these preliminaries in mind, I will now turn to and welcome Mr. David Campbell, who is the President and CEO of Evergy. Good morning, David. At this time, I will turn the floor over to you.
Thank you, Chair Keene and Commissioner Duffy and Commissioner French. My name is David Campbell. Hopefully you can hear me okay. I'm the President and CEO of Evergy, and we really appreciate the opportunity for our company to present our 5-year capital investment plan in today's session. We welcome questions from staff and CURB and commissioners, and we look forward to the dialogue. If we shift to the first main page of the presentation, I'll go through the presentation agenda. We posted a presentation about a week ago. I'm improvising, and of course, as we wait for the screen to come up, I'm sure it'll come up in a minute. The objectives of their session today reflect what was in the commission's order. So this is on the left-hand side of the page. Thank you, Cody. Always a fun moment with the IT. First is to explain and discuss the necessity and impact of our capital investments. The second is to compare our current capital plan to our previous plan and explain differences, explain the growth in the plan in a comprehensive and transparent fashion. And third, explain and discuss the customer benefits and expected rate impacts of the capital investments. And separately, we also filed updated comprehensive modeling that it was filed confidentially, which we may cover in the confidential session. So our agenda today is responsive to those objectives as reflected in the order. I'll start off and provide an overview of the capital investment plan, as well as some regional comparisons and a summary of the expected rate impacts. I'll then hand off to several of my colleagues. As Chair Keene mentioned, Kayla Messamore, Bruce Aiken, Steve Vetch, and Chuck Casely will cover the components and the benefits of our capital plan. And then I'll plan on closing our session. And in addition, several other management team members are with me this morning and will be ready to answer Q&A as needed. So if we go to slide 4 of the presentation, our 5-year capital plan is updated annually. It's through a dynamic process to incorporate changing conditions. This slide describes how we go through a review of ongoing maintenance planning and project execution, system assessment, project analysis and prioritization, what projects to include, and then ongoing analysis of our generation fleet. The process culminates in the fall and the early part of the year and leads to our filing in February. It's a very typical process. It's a dynamic environment. It's not atypical to have mid-year adjustments, and it's certainly been a dynamic process recently with supply chain, fuel cost changes in tax policy, but this is the overall format for our plan. If we go to the next slide, these plans are always a balance. We always strive to strike a balance in our planning between affordability, reliability, and sustainability for the benefit of our customers. Truly believe that if you ever get out of balance across these three, you'll end up not having the system you want and delivering the benefits and costs that you need to keep your service levels where they need to be. So on the affordability front, with respect to our capital plan, we think about investing in technology and infrastructure to keep rates affordable. And often technology can help us to lower our costs, keep rates competitive. We also think about investing in a diverse generation fleet to manage fuel and purchase power price volatility. In terms of the reliability element, we think about targeting transmission and distribution infrastructure investment to support reliability, flexibility, public safety, and resiliency in the context of more extreme weather, especially high wind patterns we've seen recently. We also think about deploying new technology to help us do preventive maintenance and customer restoration more quickly. There's a lot of tools that have come into play that help us serve our customers, keep the lights on more effectively and efficiently. And on the sustainability front, I'll just cite 2 elements. First is investing at a sustainable level to maintain reliability and customer affordability over time. If you ever sacrifice the long-term sustainability of the system by cutting back on near-term investment, we always want to strike that balance. At the same time, we also want to have the right level of clean energy investment to continue to diversify our fleet and also enable a responsible generation portfolio transition. It has to be responsible in order to keep rates affordable. So these are the elements we strive to balance as we develop our capital plan and advance it every year. If we go to the next slide, slide 6, this is a summary of the investment levels in our capital plan and changes. The main impacts on the increase in the plan reflect the expansion of grid investment and our fleet transition efforts. So the bar at the left-hand side of the page shows 5.7 billion in total capital expenditures. That was what was included in our 2021 capital investment plan. And you'll see that it increased in the 2022 capital investment plan to 6.8 billion. So the focus of today is going to talk about what drove that increase, what are the benefits that we're seeing, why do we see that increase? There are two elements that we highlight. First is the middle box of the page. It highlights two bars. One is we removed 2021, we added 2026. There's an impact of about $143 million increase from just adding a year and dropping a year. And then the second bar to the right-hand side is 905 million, which is an increase within the context of 2022 to 2025. So I'll summarize these elements and then my colleagues will go through each of them in turn in detail. Turning to 2026 versus 2021, the main reason why the investment level in 2026 is higher, it's twofold. First is inflation. You're obviously adding a year or 5 years down the road. And the second is new renewables. And in the base capital plan, it's actually a reduction and you take account of inflation. So the first piece is 5 years of inflation, 111 million increase, and that's assuming a 2% level of inflation. Obviously, inflation has ended up being higher than that, but we just assumed illustratively 2%. And we do have new renewables in 2026. We did not in 2021. That accounts for 117 million of increase. And of course, if you take account of inflation, 85 million reduction actually in base capital expenditures in 26 versus 21. And Kayla will discuss some of those elements when she goes through this slide. The next page goes through the categories of the increase in our 2022 to 2025 plan. 80% of the increase in that plan, or 905 million of total, or 80% of that is driven by our updated resource plan. So changes in our generation plan, as well as investment in distribution. So Kayla will go through what's driving the investments of 550 million in new generation, which is about 60% of the increase. She'll also talk about the investments we're making in our existing generation fleet in the context of higher wholesale market prices. On the distribution side, that's the second biggest category of the increase. That's partly in response to the feedback we received in the STP workshops in 2021 from the commission and other stakeholders around the benefits of relative increases in distribution relative to transmission. So Bruce Aiken will talk about some of those investments on the distribution side. Transmission has had a relatively modest increase, only 3% of the total. Steve Vetch will cover what are the elements of our transmission investment. I know that's a topic area of high interest to the group today. And then Chuck will talk about our customer and technology investments and what we're doing on the customer experience side. So the key takeaways from the overview, emphasize first, our capital plan is updated on an ongoing basis. It reflects changes in market conditions, and we file it each year, but it's always a dynamic plan. Second, in updating our plan, our goal is always to balance affordability, reliability, and sustainability for the benefit of our customers in the long-term, our near-term service, as well as the long-term performance of our fleet. And third, the 2022 capital investment plan includes updates to our resource plan, the biggest driver of change, new customer technology investments, increased investment for distribution modernization, as well as generation maintenance, along with inflation. So the next section that I'll cover relates to regional comparisons. And the reason we wanted to include this section, we know how important regional rate competitiveness is to our stakeholders in Kansas, to our customers, and it's something that we watch closely because we know that in particular as a result of investments in our coal fleet that our companies made in the late 2000s and 2010s, our relative price position flipped relative to states that were more heavily invested in natural gas. So in that period, our rates trended up, while with lowering natural gas prices, our regional peers trended down. I'm happy to report that since 2017, Evergy rates have been flat, while regional rates have risen 8%. That's for our peer utilities and peer states, while inflation was 18%. So driving changes in our regional rate competitiveness does take time. And we are a big infrastructure business, can't turn the ship quickly, but we're pleased with the progress we've made. The green bar reflects our rates since 2017. This shows a 12-month rolling average, given the seasonality. The blue bar, dotted bar, reflects regional peers. So those are the states that are included in the regional rate study that the commission staff performs every year. And then the orange bar is inflation, which of course has ticked up sharply in the last 2 years. Now, it's rather than percentages, it often helps to understand what it means in absolute rate terms. On an absolute basis, regional state average rates have increased by 8 times relative to the rate of increase for Evergy, Kansas. So these bars reflect the change in cents per kilowatt hour by state since 2017. So you'll see Evergy is at the far right. We have had a 0.1 cent increase. North Dakota has performed better. So kudos to North Dakota, they're 0.2 cents down. And then some of our peer states, including Colorado, Minnesota, and Oklahoma, have gone up more than a penny. So again, this improvement in regional rate competitiveness, we know how important it is. This reflects how we've made ongoing progress in narrowing the gap. Now, how have we made that happen? This progress was driven primarily by cost savings. There were reductions that were enabled by the merger, and we've been able to exceed our merger targets. So the bars at the left show the cost savings that we have achieved. So we've achieved more than $225 million in cost savings since 2018. We've not had a rate case in Kansas since 2018, so these will be folded into our rate case that we will file next year in 2023. It's been multiple levers that have enabled this, enabled by the merger, implementing employee ideas across our entire business. We've delivered or will have delivered $225 million in rate credits by the time we get to the rate case. And we're pleased that these cost efficiency gains did not come at the expense of our operations or our performance. And we just have a couple slides on that. Obviously, the purpose of this workshop is about capital, not performance, but we want to include a couple elements because it's very important as we drive those savings that we keep up our performance levels. So we'll include 2 slides. First is on customer service. So we've made significant improvements in our JD Power rankings, or JD Power customer satisfaction scores. As you know, that's a comprehensive set of polling questions that are administered by JD Power across the utilities industry. In 2018, as shown on the left-hand side of the page, unfortunately, in the Midwest large utility peer set, we were ranked 15th of 15. And we're pleased that in 2022, these polls are conducted quarterly. Year to date, we are now 5th. Now there's more to do, further progress to make, but this is an ultimate measure is how your customers rating you. So we're pleased with this performance trend. And if you go to the next slide, a very key operating metric, usually the metric that is often the most important indicator, not only for how everyone's going home safely every day, but it's really the lead indicator about how your operations are performing is safety. Our safety metrics have improved by 60% in parallel with cost efficiencies and customer satisfaction enhancement. All credit to this goes to our employees for the attentiveness they're showing in their day-to-day work. We're a hazardous business. We work with energized power lines, work at power plants where you have equipment under high pressures, high temperatures. We've had a 60% drop in both OSHA recordables and days away restricted and transfer duty cases. That translates to, in real terms, we're talking about people. So in terms of DART injuries, we had 48 in 2018, and through November in 2022, pleased to report we've had 16. Now we want to get that as low as possible. Obviously, don't even want to have one, but really proud of our team's performance on the safety front as we've driven those cost improvements. Okay, so why have we been able to achieve improvement relative to our peers? It also reflects Evergy's diverse fleet. It's softened the impact of high gas prices, natural gas prices, when compared to more gas-dependent states. The left-hand side of the chart shows a 2021 natural gas fuel percentage for electric utilities. Evergy 4%, Colorado as a state 29%, Oklahoma 58%. The right-hand side shows a rate trajectory when natural gas prices rose dramatically. That's the orange line. You'll see both Colorado and Oklahoma, the total state 12-month trailing average rate increased close to 15%, while ours were virtually flat. Now, our customers benefited from our diverse fleet really for 2 to 3 decades, from the 70s to the 90s and 2000s from our coal fleet. We lost that benefit in the 2010s when natural gas prices were low with the advent of fracking and shale gas, but that tide has started to turn, no doubt, with a big increase in natural gas prices that we've seen. So our diverse fleet is showing those benefits again. I won't dwell on this chart. It's really just to show that commission staff has gone through a rigorous process of identifying peer utilities It's a pretty broad set that they used for the analysis of the growth in our capital plan, reflecting they wanted to use electric-only holding companies. We've also have peer sets that are regional in nature. That's reflected in the hash blue and the light blue. So as we thought about this presentation today and what we needed to cover, we highlighted some elements from staff's report. So the left-hand side, staff noted that our total CapEx growth rate was in line with our regional peers, slightly below the regional average. But as noted in the right-hand side, and I know the commission commented this in their order as well, there was concern over the relative growth rate in our capital plan. So in other words, while our ending point, the total growth rate in our capital plan is still a little below average, we used to be even further below average. So there's been a relative growth rate that's higher. Now we want to go through that and cover that in some depth because we want to make sure we're hitting both those points. You know, it's not just about maybe the ultimate metric is the absolute level of investment. That's what's going to drive regional competitiveness, but trajectory matters too. I think Commissioner French mentioned on that. So we look forward to discussing that today. So first we'll start with the historical context. This chart shows 2019 to 2021 capital expenditures relative to starting property, plant, and equipment. So it's a good proxy for rate base that you can pull from public data. The companies listed are those that the staff used in their peer set. The dark blue bars are electric-only holding companies anywhere in the US, so that's far afield. And then the shaded blue are the regional peers identified in the report. And you'll see on the historical basis, Evergy was close to the bottom. So only OG was lower. Now, I will note there can be consequences for being at the bottom over time. Your system may end up being less resilient. It may have less advanced technology tools. You know, there's some happy balance in where you want to be, but certainly the case that your regional rate competitiveness over the near term should benefit from having a lower rate of investment, as long as you're not investing too little to jeopardize reliability and service. But if we turn then to the go forward look, looking forward, Evergy is projected to remain below average on investment levels. But as noted by staff, we're not at the far right. We're now towards the middle, just below average. So the 15.8% growth, and this is 2022 to 2024 capital expenditure estimates relative to a 2021 starting point. You'll see that Evergy is at 15.8% versus a regional average of 16.1%. So we're just below average. Whereas the US peer set is a little higher, a little bit over 20%. So that's the impact of having a higher growth rate is still below average, but below the point. To reflect how dynamic this can be, we've updated staff's analysis based on company disclosure since that time. It's not uncommon for companies to update their capital expenditure plans in the fall in their public market disclosures. And interestingly, all the regional peers identified by staff have increased their capital investment plans, and in some cases quite significantly. So when factoring in updates to peer capital plans, we're relatively more favorable relative to the peer average. We're still at 15.8%. The regional peer average is now up to 19.1%. You see some very big increases, example for Elite and for Portland General, and for Otter Tail and some others. So our relative position has widened the gap relative to average. We know it's dynamic, though. A natural question we have is what happens when you next update your plan. I think you'll see a number of companies continue to update their plans. But in terms of trajectory, just want to note this is all based on public information disclosures by these regional peers. So what does that mean in terms of relative growth rates? Including these updates, our growth rate for 2022 to 24 is now in line, as opposed to our trajectory shows a more rapid rate of increase. Before we had an 8.7% rate of increase. Our peers had a 3.4% rate. Now our regional peers are an 8.9% rate increase, same as ours. So what that means in terms of the ultimate metric, what's the total amount of rate-based growth that's expected? We remain below average by a relatively comfortable amount. But again, it's all about striking the balance. We know it. Just comparisons don't speak to what is the right mix that you have. We do think, though, that this lower ending point in terms of our total rate-based growth should help us to continue to drive improvements in regional rate competitiveness, particularly as we think about some of the ongoing fuel cost recoveries that are going to happen in some more natural gas dependent states, particularly in Oklahoma. So we expect that I believe that regional rate competitiveness improvement trajectory will continue to improve. On the next slide, we've added a couple more companies. We added in companies here that have gas and electric, so it's not as clean a comparison. The reason why we did so is we were able to add in utilities that are large service providers in Missouri and Colorado and Iowa, so regional states that are not otherwise represented in the peer analysis that we saw. So in this context, we were able to add Ameren and AEP, which obviously has operations in Oklahoma, and Alliant that has operations in Iowa. And you'll see that relative to these other publicly traded peers, we have the lowest expected rate of rate-based growth. And this is based on their public disclosures and analyst reports. So our relative rate of investment is lower than all of these different companies listed on the page, which again, we think will help with regional rate competitiveness. And, again, we want to have a plan that makes the most sense for our customers, for our system. So it's not about how peers are investing, it's what we think is the right balance. But we do think this will contribute, and we believe will contribute to ongoing improvements in our regional rate competitiveness, especially with our focus on efficiency. So section takeaways, you've been patient with me as I've gone through a lot of data. So thank you for your patience as I've done that. Hopefully it's been clear. If not, it's on me. I've got a lot of help in preparing this. So thanks to the team. Takeaways that we'd emphasize. First, enabled by nearly 20% reduction in operating costs, Evergy has improved its regional rate competitiveness. Since 2017, our rates are virtually flat, while regional peers are up more than 8%. Second, our diverse generation mix has insulated customers from the significant increase in natural gas prices, which is continuing to impact our neighboring states and having a more dramatic impact on our regional peers. And then third, while all regional peers are investing significantly to improve infrastructure, we are doing so at an investment rate well below average, continues to be below average, and among the lowest in the entire peer group. Okay, the last slide from me before we open up for the first round of questions. What does it all mean? So the next slide is a summary of the expected rate impacts of our current plan. So our summary takeaway is that Evergy's current plan enables additional investment while keeping rate increases below prior forecasts and inflation. And we know that any level of inflation, especially in the environment that we're in now, is something that we want to try to manage as much as possible. It's inflation rates across the broader economy bring a lot of pressure on our customers. So we're trying to strike the right balance because we know how important the absolute level of inflation is. The top table in this chart shows our average rates and our projections in the STP workshops, which we had in late 2020. The overall rate of inflation from 2022 to 2024 in the workshop was 2.5%. This excludes fuel. And the bottom table shows our expectations for the current capital plans from 2022 to 2026. And that estimate is in the range of 1.9 to 2.4%. We wanted to show a range because there are some things that can move. So we had some assumptions embedded, but you'll see that the rate of increase is a little bit higher in Kansas Central than Kansas Metro, reflecting the breadth of the system and the level of investment we're making, though the absolute level rates remains lower in Kansas Central than in Kansas Metro. So while our regional peers don't publish their retail rate increase projections, I do believe, in light of the data that we've seen, that based on their higher CapEx than what we have, based on the cost efficiency that we've been able to drive, their ongoing higher natural gas price exposure, some of which they'll be recovering in the upcoming years, we expect that their regional rate increases will be equal, in most cases, likely exceed our own. With that, Chair Keen, again, thank you for bearing with me as I went through it. If we want to pause now for the first round of questions before I hand it off to my additional colleagues.
Yes, very well, please. If we could come back from the screen share, please. All right, there we are. David, thank you so much for that overview. It was quite enlightening. Let's turn for our first round of questions. As I indicated, we will turn first for questions from the KCC staff. Asking questions of Evergy from the staff will be Jeff McClanahan, who is the Director of Utilities, Justin Grady, who is the Chief of Revenue Requirements, Cost of Service, and Finance, and Leo Haynes, who is our chief engineer. So Jeff, I'll turn to you.
Thank you, Chair Keene, and thank you, David, for that presentation. David, you indicated a couple of times in your presentation that budgeting is a dynamic process and could change even during the year. Could you go through some of the elements that are dynamic and that could cause those changes so folks can kind of get a grasp of why your budget might change?
Sure, and thank you, Jeff, for the question. If I may call you Jeff, Mr. McClanahan, we'll say.
Yeah, please. Yeah.
So an example on the, there are lots of examples, of course, on the sort of cost side. And this past year was, very interesting in terms of supply chain and commodity price impacts, how that can impact the capital plan. So for example, the input costs for a lot of the key elements of our capital plan went up 40 to 50% if you look across steel and some other inputs, and Steve and Bruce can go through it in more detail. So you have some projects in flight typically in any given year, many of which are multi-year, and you think about, okay, you probably want to still complete your projects, but you actually look at your project list. Say if you've had that much of an increase in factor costs, what are you going to cut off the project list? What are you going to adjust because of inflation? So you're going to end up being higher. That's an element that was not really an issue, frankly, for many years, but it was certainly an issue in 2022. How it can impact our resource plan. Another example is, you may recall, we were planning to invest in a solar facility in Kansas. We had actually submitted for a predetermination process for that solar facility. And we had not finalized the contracting for some of the key elements. And the supply chain crisis hit, the price of panels went up, and we thought, even though our initial analysis suggested that adding that plant would lower fuel costs for customers, have a net benefit even relative to the capital cost, pricing it into the teeth of a supply chain crisis could overwhelm those benefits, or at a minimum, dampen them relative to what we might be able to achieve if we waited. So that we pulled nearly $200 million of capital that we had otherwise expected. Another example that may occur next year is as we update our integrated resource plan. Our prior approach was we'd have a major update on a triannual basis, so every 3 years, but it's such a dynamic world now. The annual update now becomes a big deal. Well, the Federal Inflation Reduction Act, I'll call it the IRA, because I know there's debate as to whether it's aptly named, but what is clear about the bill is that it has very significant incentives for renewables that were not in place before. So the relative cost of adding new renewables is much lower. So our integrated resource plan will have a higher natural gas price forecast. Well, that's also dynamic, but it'll have a lower cost for renewables because of federal incentives that have a long runway. That will, all else equal, benefit the case for renewables. And another dynamic element is that the Southwest Power Pool has changed its reserve margin requirements, both by raising the percentage level to 15%, but also by recalculating the accreditation credit you get for renewables. So we now have more of a need for capacity. So those are different elements from our base capital plan and transmission distribution, or on the generation side, to our resource planning, where there can be relatively dynamic. Some years it's not as dynamic as others. We're in a seem to be more dynamic world now than we were before. Hopefully that gives a sense for things.
That does. I appreciate that. And you've answered most of this, but I still think it's worth asking for the broader audience. Given how dynamic everything is, you've got inflation running around 7% now. There's supply chain issues that as you mentioned, and an increasing cost of capital. Could you talk just a little bit or someone about the challenges in executing on the capital plan that we have before us, and sort of, I'm not asking for a crystal ball of where we're going to end up in 5 years, but just sort of add a little more to that conversation.
Sure. So it's a great question, Jeff, on what can change. So one of the elements that will be most interesting, most dynamic, relates to our new resource plans. And Kayla will discuss this in more depth, but we've assumed all generation that we include going forward is owned. That doesn't mean it's going to be owned. We'll go through a process to evaluate each individual project through a request for proposal, and that will include asking for PPAs as well as projects that we could bring into our system as own renewables. But a wild card in that process will be, is the supply chain going to loosen up? Is it going to be relatively less expensive to buy wind relative to buying solar, or will the solar supply chain free up? We had a period of excess capacity for solar for many years that flipped dramatically. So that's an element that we are dependent on the market, less in our control, that I think is a dynamic piece. And there's also a demand component to it. We have a major new source of load with the exciting project for the electric vehicle battery manufacturing plant that's coming in to DeSoto with Panasonic. And that's going to add incremental demand. It's going to add incremental capacity requirements. And there may be additional demand that comes along with it. So those are some of the factors that I think are less predictable. I think some of the baseline pieces, I think Steve and Bruce and our teams do a nice job of managing, yes, inflation and steel and other things. It will lead to a 5%, 10% band even some years in our capital expenditure execution versus forecast, because costs do go up, but we can manage those baseline projects relatively well. But we have a more dynamic environment in terms of some big new sources of demand or others. But I open up to the team. Are there things that other folks would mention in terms of dynamic elements? No. Hearing none.
Thank you for that. I appreciate it. And then I think my last question is for the broader audience. I think most folks that are actively participating here are aware of this, but could you walk through sort of the transition to renewables is driving a lot of capital investment on both the generation and the transmission side. And could you just kind of walk through the impacts of that and sort of not necessarily a percentage, but the impact of your capital investment plan based on transition and the need for new renewables, new generation? As you mentioned, SPP just changed its planning reserve margin, so that's gotten tighter, and we need more generation overall, and we've moved from what was a little bit at least of excess capacity to a tighter margin. So just walk through that for the broader audience. I think that would be helpful.
Sure, and thank you for teeing that up, because it is the biggest source of change between the 2021 to 2025 capital investment plan and the 2022 to 2026 is the addition of new renewables that reflected work on our integrated resource plan. Kayla is going to go through that in some detail in the next section, but just to summarize, we go through in our integrated resource plan, as analysis on what our capacity requirements are, what the commodity price expectations are, cost of new generation, environmental regulations, technology economics in terms of incentives, as well as what their impacts are on overall costs and equipment costs. And we run a model that tries to optimize for the lowest net present value of the revenue requirement over the life of the resources. And that's what drove the changes to our resource plan and the addition of new renewables, which in total, I think across if you include the 2021 versus 2026, it's more than 650 million of incremental investment. Though we think that drives, our analysis supports that will drive savings to customers over time. And that's because the relative cost of renewables is lower in providing energy in particular relative to alternatives. So our coal fleet provides great benefits in the current natural gas price environment. And while our last resource plan showed an expectation that we would retire the Lawrence plant, Lawrence 4, and convert Lawrence 5 to gas, I won't get ahead of the analysis, but I would not be surprised if the changes that I discussed in terms of higher natural gas prices in particular, as well as higher capacity needs, will lead to a deferral of that Lawrence plant retirement, because it will be to customers' benefit over the near term and the long term. But Kayla, there are other elements you would summarize, and I know we'll cover it in the next part of the presentation. So maybe if it works, Jeff, if we could maybe hold for the supplemental question after Kayla goes through it, because we'll try to get after some of the mechanics of how we do that analysis in Kayla's section. If I'm not getting at the meat of your question, please let me know.
No, I think you did. I just wanted to, like I said, draw out for the broader audience the fact that, renewables, while they're actually a cheaper generation source than a coal or a gas plant, for example, they do drive a lot of capital investment, including a lot of transmission needs, not just for Evergy, but across the Southwest Power Pool footprint. Transmitting generation from long distances in the high wind areas to the resource needs does create a lot of costs. I just wanted that explained for the broader audience. So I think you've answered it.
Yep, and I would echo your comments around the transmission needs. It's not really a driver of what's in this plan before us, because the investments here are not relating, the vast majority are not relating at bringing wind resources to market. But over the long term, I agree with you, that's going to be a more important element that we as a country will have to address and our region will need to address. And I know we appreciate the Commission's involvement with the Southwest Power Pool and trying to get the right balance in how we approach that, and making sure that customer costs are a consideration at the forefront, particularly when a lot of the load pockets are, this transmission system was designed for big central station generation. And if you put a lot of wind resources much further away from demand pockets, then you really got to be thoughtful about how you manage the transmission cost. So we appreciate your help with that in working with the Southwest Power Pool.
You're more than welcome. That's all the questions I have. Justin, do you have any questions?
Good morning, everyone.
Good morning.
Mr. Campbell, should I call you David or
David,
Mr.
please.
Campbell?
David,
Okay.
please.
I appreciate the presentation so far. I thought it was really informative. Also appreciate the opportunity to go through the work papers and the detailed analysis that you guys sent over ahead of time. I don't have any concerns really, with any of the data or analysis that you put forward, just for the record. But my questions are pertain to slide 26.
Yes, sir.
So there's a couple things that I noticed. I think the big takeaway on slide 26 is, the capital projections for 22 through 26 have a 4-year CAGR that, produces a rate projection 4-year CAGR that's less than what the Commission saw last in the STP workshop. But the note on slide 26 refers to sort of early 2021 STP workshop materials. And the very last workshop that the Commission saw pertaining to the STP was in, I believe, May of 2021. And there was a downward revision in the Evergy Kansas Central 4-year rate CAGR that Evergy provided, and the rationale was that was revised downward in response to feedback provided during the workshops and the process that you all went through for the STP. And that 4-year CAGR was a 1.8% 4-year CAGR inclusive of fuel, right? And so a couple points or questions. One, I think I understand why you guys have removed fuel this time, because maybe looking back, you would say we should have never tried to project what fuel prices would be 4 years out anyway, right?
Yep.
But I guess I just wanted to get it out there because those were public workshops and this is a public workshop. Is there a reason you guys didn't compare back to that revised, the most recent sort of the last rate projection that everyone saw coming out of the STP?
So it's a good question, Justin. I think are you okay if I call you Justin? Well,
oh, of course. Yeah.
Yep. So we'll do that. And we, I think part of the reason was we were just trying to we picked a reference point. I think we picked the one when we first submitted the comprehensive model. The main change did relate to pulling out fuel, as you noted, and I think you said it well. I think maybe the collective optimism of the industry and being able to project fuel costs, we all got maybe a little complacent in the 2010s, and that sure shifted on us. And I do think that we're better situated than some regional peers, but we certainly missed it, as you know, with our not to get in the weeds, but our quarterly RECA estimates. I think we'll be in a better spot for 2022 in terms of overall collections than we were in 2021 as inflation moved. So the main change was taking out fuel. It wasn't meant to be purposeful in which one we picked, other than a starting point. I think with the workshop where we went through the model in the most detail. We did respond, as you noted, by lowering we did some shifting from transmission to distribution in the I think between the December and May, December 20 and May 21 workshops. And that was a contributor to what we saw in the drop in the rate amount. But the main change was fuel. You know, the percent increase would have been higher than the 1.9% you cited, because we did project some fuel savings that ultimately, I'm not sure if they'll materialize by 24. I will stay out of the business of trying to project fuel from here going forward. But I think the main change we made from December 20 to May of 21 was some shifting from transmission and distribution.
Yeah, the other, I wondered also if a factor or a contributing factor was the delay in the originally projected 23 solar addition and the originally projected retirement of Lawrence 4 and 5. And I don't know. I mean, obviously you mentioned that earlier.
Yeah, you know, it's a great question. I was not, I had not yet started with the company in December 2020, so I'm not sure how solar played into I know there were solar capital additions in the model, but how those flowed through in fuel, I suspect it was driving a relative overall benefit that was removed when the ultimate cost of solar ended up being higher. So we'll have to do a detailed comparison. John Grace is with us, but I imagine we may have to go offline to get into the details of it. But I think you are correct that the retirement of Lawrence and the addition of solar at the time was expected to have a benefit in lowering rates, and that won't, that's not materialized, both because solar is more expensive and we are keeping Lawrence in the system because it's beneficial relative to the alternative. So I think you're right that that's going to be one of the drivers.
Okay, thanks.
John, anything
so my last question.
Oh, sorry. Go ahead, Justin. I was going to say, John, anything you'd add? Well, we'll follow up on asking those questions. You're always, so John's already started to dig, but we'll be more comprehensive on it. Please, back over to you.
That doesn't surprise me.
Yeah.
So my last question, again, is back on slide 26. And, again, we've got the takeaway that, the 2022 to 2026 4-year CAGR is less than the 2020 to 2024, at least on a non-fuel basis. But, I spent quite a bit of time with this slide. And when I look at the growth from 2022 over 2020, right, I calculate like 11.5% non-fuel rate growth for EKC, right, for Kansas Central. And so that struck me because that's almost as much rate growth as was expected for the first 4 full years of the STP. And so my question then was, well, we have much faster rate growth for the first 2 years, and then we're going to slow down relative to what we expected for the next 4 years. But where does that put us just on an apples to apples comparison of 2020 to 2024, right? And I mean, I know I have the confidential rate model, and we can go through that, and we can look at what Evergy's projections are. But I think that it would be helpful, I think, for public transparency purposes and for in terms of, what slides are made available to the public and what discussion can be made available to the public. It would be helpful if we had a comparison back, apples to apples comparison of what's Evergy's projections at this point compared back to the original time frame of the STP, 2020 to 2024 on a non-fuel basis. And then I know from discussions that I've had with John over the last couple of days that in the confidential model, there are some transfers from riders that are increasing quite a bit, those base rate projections. And I think that'd be helpful to note as well. Not the specific dollar amounts, but just what are we talking about in terms of gross rate impacts projections through 2024 and net rate impact projections through 2024. And I think the reason that's important is because we had a lot of discussion during the STP, right? We did 4 of these. Yep. And I think people are going to rightfully have a question of how's the company comparing, how's their performance compared to what they told us it would be during the STP. So I think that's it.
Okay. And so some of that we'll obviously follow up on. apologize, we didn't cover that. We obviously tried to, well, we focused on the 2022 to 26 versus 21 to 25, but I hear your question. I understand that point. I think that in the, I'm going on a limb a little bit. I think that we have looked at the data from 2018 to 24, apples and apples. I don't have handy the 2020 to 24, and I think it's about 0.3, 0.4% higher from 18 to 24. And it's largely due to just some inflation in the capital expenditures in 21 and 22, but we'll take that offline and be able to go through it with you in depth, because it's information that we're comfortable sharing, and I think will still be a look favorable relative to peers in our regional rate competitiveness, and the relative level of inflation given the environment we've been in is modest. I think it is about a 2.3, 0.4% change in the CAGR. The other thing that's interesting in the model that, but this is consistent with the STP model, is, it assumes perfect rate making in the out years. So it assumes that we'll have a rate case every year and there's no lag. So we have a true update at the end of the rate case. So there's sort of a built-in bias to the high side in the CAGR, in the sense that there's always some lag. Not only if you delay in filing a rate case, but even if you file a rate case, you'll have at least 6 months. So but that bias was reflected in the original STP estimates as well. So that's not sure why we chose something that biased to the high side, but we were being consistent in how we presented it. And I appreciate the depth to which you go through these things, Justin, and John will make sure to follow up and give the right level of disclosures, so that folks can track it in general.
Hey, no, I appreciate that. That's all I have so far this morning. So thank you.
Thank you.
So, Leo, do you have any questions?
I have nothing to add at this time, but I look forward to the rest of the day.
Okay, very well. I believe that concludes at least the questions from the KCC staff. We'll turn next to curb questions. Mr. Astrap, please.
Hi, thank you, Commissioner King, Chair King. Good morning, Mr. Campbell.
David, please. Good morning.
Okay, thank you. And you can call me Joe, Joseph, either way works for me as well. My name is Joseph Astrap. I'm an attorney with the Citizens Utility Ratepayer Board. Thank you for being here today and providing all this information and the opportunity to ask you questions and get some more details kind of about Evergy's capital investment plans. We operate from the perspective of residential and small commercial ratepayers, and the big interest for all of them is, well, what's my bill going to look like? And so we understand that capital expenditures are necessary to maintain reliable and efficient service in Kansas, and we appreciate the work that Evergy does with us and with other stakeholders as well to keep us apprised of that. And so, just kind of from my general high level understanding with these types of investments, that these things plan to be on the books for years and years to come, 30, 40 years. And customers are going to be paying through their rates, both the amounts it takes to produce this energy, but also to maintain these fixed costs. So I want to kind of go into more details about the plans and kind of learn more about the need for these investments and these comparisons of the regional rates. Your slides in the beginning talk about how Evergy is kind of in the middle of the pack when it comes to the rate at which it's increasing rates and increasing its capital expenditures among its other companies around the region. As far as actual numbers regarding cents per kilowatt hour, how is Evergy faring among those other states and those other companies? Can you give us any details on that at all?
Sure. So hold on a sec. I've got some good data handy. So the data I have is through August, and this is a material that the staff prepares and presents every year to the legislature. So obviously the EIA data is most comprehensive when you get a full year. Problem is you typically lag a year before you report on it. So that the EIA data that's reported monthly is pretty solid. It mostly reflects investor-owned utility information. Our regional rates relative to peers were lower than Minnesota, Wisconsin, Illinois, and Colorado, and we're higher than Missouri and Oklahoma and Iowa. We've closed the gap relative to Oklahoma by more than, I guess, a couple of years ago, we were nearly 2.5 cents lower. We're still more than a penny higher, but we've closed the gap by nearly 1.5 cents in the last few years. So Kansas, I would say we're still in the second quartile in the region in terms of prices. but with relative improvements, as I noted, since 2017 of more than a penny relative to a number of the regional peer states. So we're making progress in our regional rate competitiveness. I think there's more room to go, and I think we'll make more progress, for example, well, if there's a lot of natural gas fuel recoveries that are going to be passed through in our neighboring state to the south soon that will help to further narrow that gap, because we're largely in balance when we get through 2022 in terms of our fuel costs. So we'll see a drop in some of our fuel recoveries next year as opposed to a significant increase in some neighbors.
Thank you for that. I really appreciate it. A lot of these states you're talking about, they're also members of the Southwest Power Pool. Is that right?
Yes. Missouri is a mix. It's in both MISO and SPP, and with Minnesota's in MISO, but it's a mix, but states to the west and south are generally in SPP, and states to the north and east are the mid-continent system operator.
Sure. Yeah, that makes sense. Yeah, the borders are all kind of loosey-goosey, so to speak, with how the states are bordered off, but
they don't follow rivers and straight lines,
right, or maps for that matter. Exactly.
Right.
No, we talked about the SPP and the changes to the planning reserve margin, and I believe it was back earlier in the fall of this year. The SPP was also talking about redefining its accreditation for generation resources based on historical performance, and looking through the capital investment plan and the IRP as well. Evergy seems to be making a big shift towards investing in renewables and building up that kind of infrastructure. How does Evergy foresee these changes at the SPP level regarding accreditation impacting the investment levels regarding renewable capacity?
Kayla, you want to? I know that the audience may be eager to hear from someone other than me. Do you want to take a first pass at that one? So my colleague Kayla Messamore will. Sure. I'll defer to her on that one.
All right. Yeah, since I'm on camera and everything, this will work out. I can go ahead and answer the question. So I think you kind of asked two parallel questions around accreditation for thermal resources and then accreditation for renewable resources. So both of those have an impact on our overall resource plan. The accreditation for renewables is something called equivalent load carrying capability, or ELCC. And that actually was approved by SPP a few years ago. So that's been baked into our IRPs in terms of an expectation of what that would look like for renewable accreditation for the last few IRPs, because we knew that it was coming. It would be implemented starting 2023. And so starting in 2023 in our resource plan, we showed a decline in the renewable accreditation based on study results we'd gotten from SPP so far. And then for the new renewables in the resource plan, we use a kind of a default accreditation that was outlined by SPP for resources that don't have operating history to the point where they can't get an actual ELCC number. We use a default for both solar and wind, which for wind, that's 10%, so very low amount of accreditation. And then for solar, it's 50%, which reflects solar is more available during peak times generally, so it does get higher accreditation. So that's on the renewable side. That's based on a really fun probabilistic model that spits out a number for each resource, and then you can allocate it. So I'm happy to talk about ELCC in more detail if folks have questions, but that's renewables. On the thermal side, SPP is planning to implement something called performance-based accreditation over the next few years. And what that's trying to do is to reflect the forced outage rate. So basically the performance, the reliability of different resources in their accreditation. So resources that are more reliable, all else being equal, get more credit than resources that have a higher forced outage rate. The interesting thing with performance-based accreditation and what we're trying to work with SPP on before we really bake it into our resource plan is that it changes the entire construct, because it moves from an installed capacity base to a reliability haircut capacity base. So it changes the way the performance or the planning reserve margin is calculated, and it's very complicated, and it moves kind of the denominator and the numerator at the same time. So what we're going to work on in this upcoming IRP is some scenarios to test the impact of performance-based accreditation on our resources. And it'll be kind of an ongoing process as SPP does their modeling and they phase in the requirements over time. But the short story is that we expect it to increase the amount of capacity that's needed, all else being equal, because it is trying to factor in performance for thermal in the same way that they do that for renewables. So that was a long kind of explanation of accreditation. I don't know if that helps, Joe, or if you have any follow-up questions on that.
No, I appreciate that. That's good information. Thank you. I just kind of wanted to get some more insight on that since the curve itself is not part of the SPP or involved with SPP matters. It's good to kind of get that more inside look into those things. So thank you for that, Kayla. In regards, you mentioned earlier with the Inflation Reduction Act, what has Evergy done, or what are its plans regarding any funds available for the IRA in order to help kind of offset some of the investments that's making in regards to renewable and other parts of its capital investment plans that may or may not have been factored into the 2020 update when it came out back in February?
So it's a great question. And I do think the IRA is going to bring clearly some significant benefits in terms of reducing costs of renewables. So when Kayla's team goes through the update to our integrated resource plan that's already started, it will factor in those lower costs. So it should help net, especially in the cost of energy. A lot of those are in the form of production tax credit incentives, both for solar and for wind at sizable levels. The wild card will be what the change is in the technology cost itself. So relative to a couple of years ago, last year, there was a very significant increase in the cost per kilowatt of constructing new wind and solar. We hope those supply chain pressures will alleviate. So that's going to be a big question mark, is what's the balance between the incentives lowering the cost and the supply chain driving the costs up? My belief is, particularly with a higher commodity price environment, you will see more renewables offering greater benefits to customers in these integrated resource plan updates. But the good thing is we'll go through a lot of rigorous math. And as you heard, and you can even tell from Kayla, we'll have the right people doing that math to make sure we get our best view possible in making these long-term decisions in the context of uncertainty. But I do think net the IRA will reduce costs for our customers by providing a significant cost reduction for an important new source of energy. Doesn't help as much on the capacity side, as was noted earlier in some of the comments.
If I may jump in with one thing, Joe, I didn't know if you were curious about the I'm going to have to remember the acronym, the IIJA, the Infrastructure Investment and Jobs Act, which is another area of kind of a different structure for available federal funding. So like David talked about, we'll evaluate new renewables and the benefits of the IRA on those in terms of tax credits. But we also have an effort ongoing where we're evaluating every funding opportunity that drops from the DOE related to the IIJA. And we're actually, I have 2 concept papers I have to review today once I get off of this meeting. So we are planning to request or apply for federal funding under a couple of those, specifically resiliency related. We're looking at the long duration energy storage as well. There's a lot of great opportunities that we're pursuing. It's highly competitive. Everyone and their brother is trying to get GRIP funding right now, but we are putting together the very best applications that we can in hopes that we'll get some additional funding to support what our plans are there.
I appreciate the insight. Thank you. I know it's kind of a slow process and details are still kind of coming out as that bill's been passed. So I appreciate you guys looking into that and taking the time and effort to maximize funds available to offset these investments for the ratepayers. So thank you for that. Inflation's kind of been a big deal. I know it seems like Evergy's been working under the impression of a 2% inflation rate, and obviously that's we've overshot that quite a bit. And so as far as not only the inflation rate and commodity price increases, but also with supply chain issues, is that something that Evergy sees kind of as a long-term creating a new normal, or is Evergy operating with its planning here and capital investments or capital expenditures that's going to kind of revert to a before these changes? Or how is that changing the 5-year outlook every year when you do these updates?
So it's a great question. It's going to be one of the most dynamic elements to the plan. I think it's fair to say for the out years, we are assuming a return to normalcy. If you will, we haven't embedded a 7 to 8% persistent inflation. And I will say, as just sort of a citizen, I hope to goodness that does not happen. But so we do assume reversion. I actually haven't seen the numbers that came out today. And we all shouldn't react to just 1 month's inflation number, but I think it was some mitigation in the inflation rate that occurred. But in general, we assume some moderation in the inflation rate in the out years. So that would be create pressure on us and everyone if it continues at the 7-8%, and that will have knock-on effects and cost of capital and all kinds of things. But we do believe, and we're pleased that we can, our level, and as Justin's questions teed up, we've had some inflation that's had impact on us, but our overall, it's been much less than what we see in the broader economy, and we know how important that is, and we're going to strive to keep that.
Great, no, thank you. I appreciate that. That's all the questions I have now for this section. So thank you so much for your time, everyone.
All right, thank you very much. All right, David, let's turn to commissioner questions, see if we have any of those. I'll turn first to Commissioner Duffy.
Thank you, Chair King. First of all, David, I want to thank you for being here. This is a unique opportunity to talk to the CEO and for you to appear so very public in this manner. So I do want to thank you for that. That said, I've got a few things. Let me just start where Mr. Astrab left. I'll just tell you, my feelings about the IRA and the IIJA is that this opportunity comes around once, in a lifetime sort of thing. There are a lot of dollars that I believe, if they come to Kansas, will be transformative. However, it appears that while I see great opportunities here for this state in so many ways, from private industry to public entities to utilities, that I don't feel that we're being very aggressive in going after the opportunities. And it was good to hear Kayla talk about that she's reviewing papers, but I believe there is a sense of urgency from my standpoint that we respond well, that it's all hands on deck to try and get the money that is competitive, because I believe others have established teams and workforces and groups to go after these dollars. If we don't get them, somebody else does. But I don't know if they improve your company, rather your shareholders' bottom line. So will this detract from the shareholders' bottom line, or what?
So the short answer is it will not. Again, we appreciate the opportunity to be here today. So of course, I'm happy to be here. So thanks for giving us this opportunity. There's no more important place for me to be today than in this session. And I'll distinguish between the IIJA and the IRA. And as you know, the wheels of the federal government can sometimes move quickly, but often they move more slowly. So especially for the IRA, a lot of the regulations on how it's actually going to be administered are still to come. To take advantage of the IRA in the renewable space will require investment. So I suppose in some level there's some synergy with delivering savings to customers at the same time we're investing, because if you get effectively will be every megawatt hour that we generate of wind or solar will get almost $30 a megawatt hour of credit. So you start off with a cost of minus 3 cents, if you will. So we can deliver that benefit while investing. And as the regulations come out, we're planning to issue a all source request for proposal in early 2021. And we think the IRA benefits will be reflected in the proposals that we receive for that. And the IIJA is more of a medley of programs, as you know, and we're working closely with the states in which we operate, so Kansas and in Missouri. We're not eligible for a lot of those funds, but we can participate in helping the state and the different agencies that are eligible to achieve them. And why I don't see a discordant note for, let's say, for example, EVs are all funded through federal funds. We know how important rate competitiveness is for us. So at the end of the day, anything that helps to drive down rate pressures for our customers is the best thing for our shareholders. The biggest challenge for our company is when we are misaligned in relative to our regulators in terms of our level of investment and what we're spending. And we know how important it is to drive regional rate competitiveness. So anything that helps to drive that helps us as a company, because that helps us with our relationships with our key stakeholders and it helps our customers. That's the key to the long-term health of utilities. The utilities that are most successful with their shareholders are ones that have the best relationships with their states. You can look at across jurisdiction after jurisdiction. So it's a fool's errand if we think, oh, we're going to do something for shareholders in the near term if it's out of step with our regulators. But it is a challenge to try to get after the IIJA, especially because it's got so many different programs. So we're seeking to work with the state entities and help them where they're eligible and pursue where we can participate. But the IRA, we will be all over that because we need to be with the resource requirements that we'll have in light of some of the changes that Kayla described, with the incremental load opportunities associated with Panasonic and others, which are very exciting, and with the benefits it can deliver for our customers. So the IRA will be all over the IIJA. We need to keep working on that with others because it is a complicated, it's dozens of programs at the end of the day. But we appreciate your ongoing push to make sure we get as many funds as possible to Kansas because it is a unique opportunity. The great thing about the IRA is it's got a decade or more of certainty in pursuing it, but the IIJA is not. That's that's sort of a one-time deal. We haven't seen some of that size in decades.
So I have talked to staff about not anything onerous, but having you all report in to let us know where you stand on going after whether it's the IRA or the IIJA, and I believe as a commissioner, I need to be informed. And I believe the governor and the legislature need to know where are we in going after these very transformative dollars and programs. So I hope that you all are reporting in. And while I know there are a lot of utilities we don't regulate in this state, and they're small. And I hope as we learn about the potential dollars, programs, whatever, that somehow we have a network to share information, whether it's a municipal or whatever. But I've been on several webinars where a lot of these smaller utilities only have a few people. They don't have the wherewithal for some of these programs. So as we learn things, I hope you're also sharing with them. I think we lift the boat for everybody. It benefits us all. Okay, second thing. In your, I believe you said the word dynamic like a lot. This is a dynamic world that we live in now. Dynamic sounds positive. I would say there's a perfect storm that's kind of aligned with whether it's the Ukrainian war, it's COVID. I mean, all of these things have stacked up. And I guess my thought is that in this uncertain world we live in, then you said something very certain. You said that our CapEx assumes everything is owned. So part of me believes that being in this dynamic world, maybe owning things and building things isn't quite where we need to be. Also, like Panasonic happened in a relatively short amount of time, and they're going to ramp up fairly quickly. Does it really make sense to own everything in this dynamic world? Maybe really, which I think we think in short terms because we know the fallacy of thinking in long 20, 30-year terms in a way. Maybe it's best not to own everything at this time.
So I think it's great feedback, and I'll sorry if I was repetitive with dynamic.
No,
but it's it's like, as you said, it's the reality, and it's better to. I always try to look at the half full view of the challenging, some of the challenges we're in. But the on own versus, for example, signing power purchase agreements. So things we don't own. The only certainty is that our model, the Excel models have you put something in a cell. So the model says that it's owned. What's going to happen in the real world will be determined by the evaluation that we do through our RFPs and discussion with the commission. So right now, most of our, all of our fossil assets and our nuclear asset, we share ownership with KEPCO and Wolf Creek. We own 94% of it. We own all of our fossil assets, which just was the model that utilities build them themselves. They own them, and they're regulated directly by the commission. There's a level of certainty on it. Most of the renewables we have now, we don't own. We have they're through power purchase agreements. About 90% of the renewables are through PPAs. So as a simplifying assumption, we put in the model says we own them, but we're going to have to look at that, and we know we'll need to look at that based on what's the best mix that offers the best benefit for customers. If it's significantly materially more expensive all in to do it through ownership, then the commission's not going to support it, and we're going to have to go down a different path. If there's a mix of ownership and PPAs that make sense for the reasons you cite, if it offers the best benefit for customers, then that's the path we'll need to go down. So we're really more framing it as we acknowledge that in the model it says ownership, but it's actually it's a decision ahead of us, and there'll be an opportunity for dialogue around what is the best mix as we evaluate projects down the road. Because to your point, what I'm sure of is that it won't be all owned or all PPAs. It'll be some mix, and we'll have the chance to determine that over time as we see the projects. But it's good feedback. Okay. So thank you.
Yes, and I would like, you talked about nuclear. I do believe nuclear it's a small part of what we do here, but I think there is so much potential. And I have talked to the chair and staff about a workshop just to focus on nuclear potential, expanding what we have, looking at the small nuclear reactors, the SMRs. The announcement yesterday on fusion, I think there's some new potential. I know about a dozen states are already out there with legislation to improve their nuclear capability. And maybe that should be part of a workshop discussion. So if you have a comment on that, I just wanted to share that.
I'll echo your thoughts, and I think new nuclear, if we can make it work cost effectively as a country, has tremendous potential. Our Wolf Creek plant, if you look what happened with Uri, it was a tremendously reliable operator. It's about 17% of our total generation, and we love having it in the mix. They're building the new plant in Georgia now. It's almost online, but it's of course many billions of dollars, I think 6 or 7 over and 6 or 7 years after. So we haven't cracked the code yet. I think for the sake of our customers, we'll want to be a moderately fast follower as we crack the code on how to build new nuclear cost effectively. But I think we want to stay close to it. And at the right time, I think we'll want to work with the state if there's some kind of incentive program or legislative program that makes sense. But it's the new reactors, the SMRs, small modular reactors that are going in are still 5 years away or so. And most of them have very significant federal support. Then they're pretty small. So we can see how those go and hopefully benefit from some folks getting up the learning curve and be moderately fast followers. I think the fast followers will still face some of those overruns because the challenge with nuclear, and new nuclear has been about 10 years away for the last 15 years. And maybe it's 5 years away now, but it's still out there. And I think if we follow at a good pace, it has tremendous potential, particularly if we want to get to net zero by 2045, 2050. We're going to need, I believe, new nuclear or carbon capture and sequestration at a very significant scale.
I appreciate hearing that because just listening to the webinars and where the labs are, and if I look at Wolf Creek, my understanding is it was cited for more than what is there right now. So a lot of the NEPA, maybe we wouldn't have to go through. And we need to explore, I think, a potential for nuclear, and 5 years is not that far out. And it is amazing what, as I talked to a scientist and how he explained the whole construction, it's made in the factory, delivered, and then assembled. And so just the whole facet of nuclear has changed. So thank you. That was good to hear. Okay, so you mentioned if we're going to be carbon free by 2045 or 2050. So let's talk energy policy. You're at the top of the food chain there. I would appreciate knowing what you believe you need as a utility from us, more importantly, the legislature, in terms of energy policy to help guide your decisions and, frankly, our decisions. As I look at other states, I believe what we have on the books is woefully inadequate and therefore does not allow a real focus point for us to follow. And I don't mean extreme. I'm not talking extreme, but so much of a state's ability to improve, whether it's energy efficiency or whatever, I believe is wrapped up in the policy that's from the legislative standpoint. So I would like your reaction to that.
Okay. So I think as I step back and think about Kansas' situation relative to others, and separating our region versus nationally, because you have some, particularly if you look at California and New England, or West Coast and New England, you have some more aggressive state level support for the clean energy transition and much higher rates, in some cases double or close to double our rates. So there's a set of choices that are being made there that I just don't think work for us. And most of our regional peers, with the exception of maybe the state to our west and a couple states to our north, so Colorado, Minnesota, and some others, are being much more aggressive. But again, their rates are, we're higher than they are. They're higher than we are. And it's going to only increase further for those other states because of their policy. So I think there is a balance on that affordability and sustainability front that we need to strike. We've actually made very good progress in Kansas if you step back in terms of the emissions-free mix. So the sheer amount of wind we have as a share of energy, I believe, is the highest of any state. We're right there with Iowa. We've got a nuclear plant where we have a relatively a different mix than some, is a relatively higher mix of coal. So we've got a profile, for example, a company where we're half emissions free and almost half coal. Our natural gas mix is 5%. So when we think about the transition ahead, it's going to be, how do we work with our regulators, with the legislature on a managing an effective transition away from coal, not in 10 years, but over 30 years. And I think we can drive that. I think the securitization bill that was passed by the legislature is hugely important because particularly if federal policy changes and mandates closure of coal, we will probably have some undepreciated balances in those plants. So securitization is a way to retire coal cost effectively. And that's going to be very important. I do think energy efficiency, and I know, we were webcast. I don't know what but I think energy efficiency is an area that on most measures, there's less happening in Kansas and some other states. So that's an area where we're the biggest utility. So we own that. So we as a state can do more on the energy efficiency front. And I'll sort of leave it there. I know that's an active discussion elsewhere. In terms of how we're going to transition away from coal, and I'm not trying to dodge or duck the question. I don't think it'll be a state legislative mandate as much as it's going to be, is a technology enabling it? And can we strike the right balance in affordability? I'm glad that we're not on the front edge and having 20-cent prices, that we've been able to drive as much wind as we've had with the federal incentives that have been there. We now have the IRA, which is going to help do even more. So we'll be able to replace our coal energy with cheaper renewable energy. The challenge we're going to have to solve is how do we make sure we still have the capacity? We can run coal seasonally, but we may have to add more peaking units. That's probably as much a federal permitting issue as anything else. So we're going to need to be pragmatic, I think, in Kansas about permitting peaking gas. We can't just say no to gas. We're going to need some capacity to help, especially in the winter. So I think the state level will be helping in the permitting. It's going to help with securitization. It'll be maybe some areas like nuclear, but a lot of the technology trends that are necessary were less dependent on state policy than on broad nationally. I hope that makes sense. But I really appreciate the securitization work and then the dialogue around the integrated resource plan. And and making sure we're balancing affordability as we add renewables is going to be the challenge of our times, if you will. And I think with open dialogue and a lot of analysis around it, we can strike the right balance.
Okay, finally, I would just add, do you believe that are we having effective open dialogue between your company and our staff?
I do believe so. And I hope, obviously we welcome staff's feedback on it. That's certainly our objective. It's critical for our success to have that. So that's important, and starts tone at the top. So hopefully you and staff are seeing that from me and seeing it from all of our company. And it's not just in settings like this, it's in offline sessions and talking about what's happening with capacity or with Panasonic. So I think we have that regular dialogue. And if we, don't, then that starts with me. So let us know if we're not, because I think we do have that dialogue, and it's critically important to our success. So I think the answer is yes, but we're always open to feedback if we're not doing all we should.
I believe we do as well, but I understand there are some states where maybe that's not occurring in such a robust way. So I hope that staff continues either online or offline to have very direct and robust conversations with your staff. So
we do, and I think as you saw in the questions that we received earlier, it's a very informed and robust and constant dialogue we really appreciate with Jeff and Justin and their teams.
Yes, we're lucky to have them. So again, I want to thank you for being here, and thank you, Chair Keene, for this opportunity.
Thank you, Commissioner Debbie. Commissioner French.
Thanks. Good morning, David.
Good morning.
And I'll echo what everybody else has said. Thank you for being here. And I mean, you and the entire leadership team, I mean, it does mean something that you've prioritized this to share this information. So, and I'll just tack on to that last conversation you had with Commissioner Duffy. I mean, I and the other commissioners see the engagement that our staff has with Evergy, and I personally know that there's not always agreement, but there is an incredible amount of engagement. And I guess I'll just say I have a side frustration when I see these rankings come out about whether we're a constructive atmosphere, regulatory atmosphere or not. And it always amazes me that we're not considered constructive, because I think there is an incredible amount of dialogue. And just because we don't agree on every issue, I think our staff does a fantastic job of keeping that dialogue going. And you all, I think today's evidence of our ability to engage together even when we don't agree. So that's just a comment. Frankly, a lot of my questions and concerns about your slides have been addressed through a lot of conversation. Jeff took my first question right off the bat. I was going to ask, what you see as the most material areas of uncertainty that could drive new updates to your capital investment plan. I think, you talked about inflation, you talked about incremental load, need for new generation, potential new renewables. So I think that's answered, unless you think there's something more on that. But let me ask the flip side, which might be a more difficult question to answer. So that those are the items that could cause upward revisions. They're the risks. What are potential opportunities that could cause material downward revisions in the next 5 years? Are there areas of uncertainty that could actually be beneficial and allow us to reduce our capital spend?
So that's a great question. I think, with respect to who's building, obviously the renewables could end up being through PPAs rather than owned. I don't know that has a customer impact on cost, because we'll be looking for what's the most beneficial. So customers will just be paying a pass through as opposed to paying a mix of energy will be a negative cost, but a capital piece. But that's more shifting geography, if you will. On the investments, there's always a balance to strike. So I think there's, from the last STP workshops, we did some shifting from transmission and distribution. That was a part of feedback of different stakeholders. And over the near term, you could see more of that. I know part of the commission's feedback in the order was, can we just have lower levels of capital expenditure? I do think there's a reason why you're seeing the levels of investment we have, that if we cut back on some of the replacements that Bruce and Steve will talk about, that there'll be consequences down the road. We put off investing in our T&D system in the 70s, 80s, and 90s, and it's unfortunate. We were very focused on generation. A lot of those generation costs, especially nuclear, went over, but we face what we have, so we're going to have to make those investments. There's actually not a lot of room to change that. What I think will be beneficial is, the cost impacts can change. So for example, if the supply chain normalizes for solar and for wind, we're seeing some utilities that are signing up for 2,500 a kW, whereas a year ago it might have been 1,100, 1,200 a kW. If we can get back down to those lower rates, then when you factor in fuel, you will see a reduction in costs, not a mitigation or reflection, but actual reduction in costs, because you'll be able to replace things that we are modeling as sort of neutral to costs that are going to be lower them. So I think the biggest opportunity is going to be in the old steel for fuel trade with a big federal subsidy and a normalized supply chain. I think adding renewables will lower costs for customers, notwithstanding the investment. That's probably the biggest thing I'd cite. Realistically, I think a lot of the other investments are ones that we're going to need to make. Now, energy efficiency is one that if we drive more, that will help to, that will reduce customer bills over time, and could have some factors. The other piece that could drive reductions is growth. Growth is a wonderful tonic, because you can just leverage the fixed cost of the system more. And I think Panasonic is a great example. And I think we'll see more growth. We'll see some growth that comes with electric vehicles, just as what's happening with the auto OEMs. And with growth, you can just get a little more efficiency in your cost structure and your infrastructure investments. So those are probably the wild cards I'd cite. The base level investment, and again, we could always shift some things around, but I truly believe that it's ultimately going to come back, just because of the nature of the system that we have.
Well, I appreciate your comments on growth, and I agree with that. But I do want to say, I also appreciate you not blowing sunshine. I think your comments about, the fact that we probably did put off investment, and that's created lumpy investment now. That's a point well taken. I don't know what we do with it.
Yeah.
But I appreciate that you tried to give me a realistic answer there. Now, your point on growth, though, leads me into, the one remaining topic I had, and I think this was slides 19 and 20. You're showing relative investment versus net plant for sort of your peer utilities. And, I think that the point is Evergy is spending, on the low end to the average end going forward versus its peers. And I don't know if this is a criticism, but it's certainly a question I had come into my mind as I looked at that metric. Is it doesn't seem to indicate, those charts don't seem to indicate to me what the spending's for. So what percent of that spending is to meet load growth or new customers, versus what percent of the spend is just to rebuild the system that you have, or to replace existing generation? And I guess the question I'd have is, have you looked at trying to benchmark against those peers to understand where you may stand on a percentage basis of, is your spend coming from, to meet growth or to rebuild versus what they're doing? If you haven't, I'll just say I'd love to see benchmarking in the future to see if we're generally in line on a metric like that. So I hope that question made sense.
It does. And we've tried. It's very hard to get a breakdown on a benchmark basis, particularly for investment. You can for new generation typically. So you'll even see a chart, I think Kayla will go through it, around a relative level of investment in new generation. But even that, to your point, it can be hard we do it relative to rate base, but there are some different circumstances. So it is hard to benchmark investment. We do benchmark costs. So we could be happy to go through that. We think have improved significantly on the cost metric, given our absolute cost savings we've had when most of our peers have gone up. So you can benchmark costs, you can benchmark, your coal plant performance, but it's the investment part that's hardest to benchmark. The ultimate scorecard that sort of takes account of growth and investment is rates. Of course, there's some lag, but that's the ultimate scorecard, because if one entity is investing more but also growing more, their rate impact will be less than an entity that's investing just as much and not growing. So we try to have this sort of ultimate scorecard over the rate trajectory in there as well. But we'll keep looking in the benchmark side. It's just the investment piece is harder to benchmark. But if we are able to find it, we'll certainly be happy to go through it.
All right, I appreciate that. I'm going to just stop here because I think we need to get moving. I could talk about generation mix and load growth, Kayla knows, for hours. So I will either hold those questions until after Kayla's presentation or just hold them forever, depending on how we're doing for time. So, but I appreciate it.
Thank you.
All right, thank you, Commissioner French. David, I want to join with my colleagues in thanking you and your staff for your participation and the level of granularity with which you're willing to approach the subject matter and the questions that we have. It's very thoughtful. It's very insightful as well. So thank you so much for being a part of this. My first question is really dovetails right on to the last question asked of you by Commissioner French. So I'll ask you kind of the devil's advocate question here, if I can. When I turn to your slides that demonstrate or attempt to make some peer comparisons, and that would basically, I think, be slides 19 through 21.
Yep.
Yeah, 19 through 21. I think it's helpful to an extent, but I'm kind of really left asking myself the question: how relevant are these? How relevant are these comparisons? And I say that in a respectful way. I mean, after all these different electric utilities have different accessibility to renewables. They have different baseload fuel mixes. They have different degrees of compliance with the clean air and other regulatory requirements. They have different RES standards, if they have them at all. Some states have energy plans, some states don't, that these utilities are trying to comply with, and how they go about doing their capital expenditures. Some have excess generating capacity, and their vulnerabilities are different. So I guess what I'm suggesting here by this question is that while I think on kind of a macro level, these comparisons that you present are helpful. It provides a basis of comparison. It strikes me that these comparisons have really significant limitations.
I agree. I would describe them as they are not inputs to our capital plan. They're a comparison of outputs. And we include them largely to inform our view of what do we believe is going to happen in terms of regional rate competitiveness. Now, to the dialogue earlier I had with Commissioner French, there's a lot of other variables too, right? What's the relative level of growth? Then we try to isolate regional peers. There's some similarities in growth, but there's some differences. So we include this in the regional comparison section because it's a measure of, if we were investing at higher levels, it might further accent concerns around regional rate competitiveness. We think that given our emphasis on cost efficiency and the relative level of investments, it just gives you some output view of our relative level of regional rate competitiveness. We've got some confidence around it. But I agree with you, assessing the capital plan is going to be driven by the inputs, which is more of what Kayla and Bruce and Steve and Chuck are going to describe, because the inputs are what do we think we need to do, and otherwise this is a comparison of outputs. But it has limited utility at some level. I agree with you. So that's why we include it in the regional rate competitiveness section. It's more of a check at a top level, but the ultimate scorecard is what the rates are.
Fair enough. I agree totally. That's what we're all about, I think, here is a concern about reliability, affordability, and for me, resilience. Those are the components here that are really critical, because that is what plays into rate competitiveness. Is what plays in, more importantly, into the ultimate cost to the ratepayers, which is, I think, what we as a commission have to be about. I'll save for the others, David, the questions I have about how our total generating capabilities compare with demand. I'm going to defer that for them. I may want to come back and ask you some of those questions too, if you wouldn't mind, if you're with us then. But
I'm not going anywhere, so okay. I'll be here the whole time. Yep.
Okay, super. My last question is, probably simplistic, I'll risk it. We have a wide audience here, I think potentially in terms of the reach of this workshop. So I'm going to kind of come back to, so we can get away from some of these Department of Defense phrases that we use that may be lost on some out there in the audience. Under either the IRA or the IIJA, under either of those, give us kind of a brief summary, if you would, of how your costs are mitigated by these with respect to generation.
So I think I'll go with the IRA. The IIJA has some narrower elements, probably less in generation. But the IRA has some significant components. So it offers a production tax credit, which is in effect, if you generate, it's for wind and for solar. Before, you only had what was called an investment tax credit for solar, which you could get as a lump sum to offset part of your investment costs. Now, you can elect a production tax credit for wind and solar that's close to $30 a megawatt hour. So it literally says, the resource is free, so you're not paying for fuel, but every megawatt hour you generate, you're actually get a tax incentive equal to almost 3 cents. Our average total rates are in the 10, 11 cent range. So it's a 30% off the top negative, you're paid to produce. That's a very significant benefit. And one of the elements that's significant too is that it's effectively for 10 years. So in other words, you've got certainty in your generation planning for the next several years. In the past, we've had incentives for renewables, but it was almost up to an annual renewal cycle. They'll decline over the next 4 years. Maybe they'll get renewed at the end of the year, so it's harder to plan. In our business, you benefit from knowing that, hey, you're going to have this incentive for many years. Now, as taxpayers, we're going to bear that burden, but as Kansans, that's already out there. We need to factor in for our customers. Now, when we run the math on building new renewables, they've got a big cost advantage because of that federal subsidy. Now, that doesn't help with the capacity. You're still going to have to solve for capacity, but all else equal, you're going to see more renewables pencil out in our integrated resource plan because it'll be lower cost for our customers because of that piece. There's also a nuclear production tax credit. We haven't written the rules yet. It starts to go in effect in 2024. But the way it's written is, if your nuclear plant realizes below a certain price, below $25 a megawatt hour, you can get up to $15 a megawatt hour in a nuclear production tax credit. And it explicitly says that regulated plants are eligible. That's important for our customers because our Wolf Creek plant, actually, I didn't see the day ahead for today, but yesterday, our Wolf Creek plant, the average for the whole day, the average price of Wolf Creek received for its generation was minus $8 a megawatt hour. So because of congestion, because of the transmission highways were full, because of the transmission grid was not built with enough wind in mind that we have, there was congestion in the system and Wolf Creek was getting a negative price. If after 2024, Wolf Creek gets an average price below 25, then our customers should get a benefit of that nuclear production tax credit. It'll be fully a pass-through. That's also a beneficial element. I'm fascinated as to how the rules are going to work. Are they going to wait till the end of the year? Are they going to base it on the day-ahead market or real time? There's all kinds of details that are interesting to, so the wonks like me. But at the end of the day, I think with our renewables profile in Kansas, that should be a savings that our Wolf Creek customers will benefit from. And it's a little bit of a red herring to say, well, we ship some of that power to Missouri or otherwise, as you all know, effectively half the plant was initially funded by Missouri customers. It was a jointly owned plant. So it's going to be of great benefit to Kansas customers with that nuclear production tax credit. So those are two examples I'd cite in the IRA that are material. There's also a big subsidy for hydrogen production, for carbon capture and sequestration. Those technologies have really yet to be developed, but there's a long runway for those. So I think that those could actually be of real benefit to our customers as well. We're not in the R&D game, and I don't anticipate we'll be coming to this commission to ask you to help us fund expensive early demonstration projects on our customers' nickel, but there are a lot of folks who will fund those. So we will be in a position to follow on that. And that offers real potential for our customers as well. So those are just a few of the things I'd highlight in the legislation. The Infrastructure Investment Act has some support for transmission and otherwise, but it's small enough dollars that it's less direct impact. A lot of the IIJA support will be in some of the research areas that help in some of the technology fronts, and will be less directly impactful to customer rates on the generation side.
Okay, that is very helpful. Thank you for that answer. Same question, and you've broached it. Maybe you've answered it. You broached it at the very end of what your response was to my question. But the same question with respect to both the IRA and the IIJA. What are your main how are your costs mitigated with regard to transmission?
Well, there's the IIJA includes the potential authority for DOE to aid in building transmission corridors and siting. How that works relative to state authority will be interesting. I think that I don't think that will have a material impact. I think that this commission and the state has that provision will be more relevant for some other states where it's almost impossible with transmission. There's some lending support for big transmission projects that may be relevant for large merchant lines. When I say merchant, so outside of the regulated asset base. Having worked in that space earlier in my career in Texas, those are hard to get done, even if you did have some lending support. So on the transmission side, there will be, I think it'll be relatively modest because the amounts of transmission support relative to the sheer level of transmission investment needed, I think it'll have relatively modest impact on the transmission space. I'm looking around at my colleagues to see if they have a different view. So Kayla, do you want to jump in?
Yeah, I can just add a little bit on that, Chair Keen. So one area that we are focusing on from a transmission perspective within the IIJA is that we have started working with SPP and MISO on some of the interregional transmission provisions. So that's less within we're actually not eligible to apply for those, but we are supporting SPP and MISO as they try to get that sort of funding for interregional projects. Like David said, on the resiliency side, the scale of the language and just the way that it's written is a little more distribution centric. So we are focusing on some more targeted distribution programs with those concepts. But for transmission, we are trying to get the interregional, which given the dynamics of cost allocation and regional funding and all of that are a little less direct in terms of their impact on our actual capital plan. But that is the area we're focusing on based on how the IIJA is written.
Thank you, Kayla. When we come around to your part, I have a couple of questions I'll address with respect to those issues you just noted. So basically, then what I'm hearing you say then with respect to transmission, the lion's share of all the costs of transmission are going to be borne by ratepayers.
I expect that will be the case. I do think that particularly transmission projects, and we're seeking to work with the Southwest Power Pool on this, can have a payback in terms of reducing the overall power costs. And it's the underlying premise, a lot of these pools, while they're initially set up, right, is that you can more effectively leverage generation resources across different companies. There are definitely lines that will help, like, for example, the additional transmission line out of Wolf Creek should help to alleviate some of those negative prices that I talked about that Wolf Creek experiences a fair bit in the fall and the spring. And how that helps customers is that, yes, there's an incremental transmission cost. In that case, we're not building it, it'll be a different company, but that will be syndicated through SPP. But that additional transmission cost is going to be offset by a lower cost that our big low pockets have to pay because the generation is actually reaching them as opposed to being bottled up on the highway. So the transmission investments require a little more modeling to get after the benefits, but they do certainly offer reliability and resilience benefits, and as well as the overall cost of power across the system that can really help with reducing congestion.
All right, thank you for that. Again, I'll defer to a later time today for my questions about cost allocation within SPP. I think that's a huge concern. I have a major concern about that.
Chair Keen, could I ask one follow-up just on that last line of questioning?
Please do.
And I'm sorry, this is probably one I could have held anyway, but it seems relevant as we talk about, sort of there has been a very large transmission cost associated with going out and grabbing remote resources. It does looking at the GI queue, the generation interconnection queue, that we are shifting more toward a look of solar and storage and maybe adding some more central power. Do you anticipate the fact that you can site solar and storage closer to load or more strategically, do we think that's going to have an impact to help curb the growth in transmission costs moving forward?
I do agree that the siting of solar now this and storage can be more complementary in many cases than wind. So that will the relative impacts for congestion. You know, it's as my colleagues have always taught me over the years. I'm not an engineer, that the distance is not the sole factor that will drive the transmission network. But in general, I think that you're right. The best solar resources are still in the western part of the state, but the relative differences are lower in the wind side, and still easier to site solar in many ways, just in terms of the profile and land availability. So I think that will be a help. And I do think that we have so much wind in Kansas, the profile of solar offers a better capacity accreditation, and that's also a help. My personal view is that the wind is going to become a bigger challenge over time, and the solar accreditation probably is not going to help for the winter, but it is of help for the summer, and that's material. So I do think that will be a factor over time as we add more solar and storage. Storage at scale, it still really works best in markets like California or Texas, where you have a lot of intraday volatility because they're 4-hour batteries. They still don't add as much value for us here in our market, where we have less the intraday volatility. Will be long duration storage that could potentially be a game changer for us over time. Anything you'd add, Kayla, or anyone else, Jason? Okay.
Thank you. And sorry for the interruption.
No interruption. Appreciate the question. Thank you very much. Well, David, that concludes my questions for now. I think we are in need of a break. It's probably most particularly you. You've been on the hot seat. You've acquitted yourself very well, but holy cow, you've been doing that now for nearly 2 hours. My inclination is to combine this break with lunch, unless we have any serious objections to that. My thought would be, it's about 11:23 now, that we take our lunch break now. We resume at noon. And at that point, we continue with Caleb. So without hearing any objections, are we good to go with that? Without serious objection, then that is exactly what we do. We'll stand in recess until noon. Thank you.
Thank you.
Jaden, could we go back out to full screen, please? Okay. Commissioner Duffy, are you back? Okay, it's noon now, and so we're back on the record. David, I think what I'll do is I'm going to turn back to you, and you may turn to whomever you wish.
Thank you, Chair Keen. I will hand it over to my colleague, Kayla Esmore, who will lead the next section. Kayla, take it away.
Sounds good. Thanks, David. And good afternoon, everyone. I will stall for a moment while the slides come up. And we will start out with a new section called Benefits of Capital Plan. Waiting just a little bit. All right. Perfect. Can you go back one slide? Yeah, so in this section, I will start it off and we will have a break for questions after I cover the first sort of two subsections within this, which I'm excited. It sounds like people have held questions for me, so I can't wait to hear what they are. So we'll get to that after I'm done and before I hand it over for the other categories, other speakers in this section. So throughout this section, what we'll talk through is the drivers of the change in the capital plan from 2021 filing to the 2022 filing. And we wanted to break down those differences by category, so we could specifically explain the drivers within each investment category. And then we can talk about specifically the benefits that are unlocked from those changes and from the overall level of investment in each category. So I'm going to start out with the new renewables section. Oh, actually, I'm going to do two quick overview slides first. So slide 27 is a slightly more detailed version of something David showed earlier. And I won't reinforce or reiterate everything that he said earlier, but as we talked about, the 5 years of inflation account for about 111 in this difference between 2021 and 2026. And then the new renewables is an additional 117 million difference between these years, which is basically the difference between 0 megawatts of renewables in 2021 and about 83 megawatts in 2026. As David mentioned, there was a reduction in base capital, sort of ignoring the impacts of inflation, of about 85 million and between the 2 years. What we wanted to call out on this slide is that in addition to that reduction in that base level of capital spend, there's also a reallocation within the categories, which you'll see kind of on in each subsequent category section. But as we finished IT consolidation projects after the merger, finished up some environmental work in our existing generation plants, there was a shift of that spend and that investment from those categories into T&D, which allows us to do more aged infrastructure replacement and more of the types of investment that Steve and Bruce will cover later in the T&D sections. So the next slide, David covered this exact same slide earlier. So I'll just remind folks that looking at 2022 through 2025, 80% of the increase between the two capital plan filings was driven by new renewables, which is what I'll cover first, and then distribution investment increasing. So without further ado, now I will jump into new renewables and the specifics around this particular category. So before I talk about this category, you will see this slide at the beginning of each section within this broader section. So on the left-hand side, we've broken down that category in terms of what was in the prior 2021 capital plan, what was the removal of 2021, the addition of 2026, and then the change within 22 through 25 for that specific category. And it's broken down for Kansas Metro versus Kansas Central. And then on the right-hand side, we'll describe what drove the updates to the plan between the two filings, and then a really high-level description of benefits. In each section, we'll have several slides that sort of enumerate the benefits in more detail, but wanted to have one quick summary for each category so that folks could have that for reference. So for new renewables, in the 2021 capital plan, there was 441 million in investment in new renewables across that time frame. As I mentioned, there was no generation investment, new generation investment is assumed in 2021, but there is in 2026. So there's that 117 million increase driven by that change. And then within 22 through 25, there's that 550 approximate million increase in spend. And that was driven by two primary things. Really, whenever we see changes in the new generation category, it's going to be driven by changes to the resource plan. So essentially, how many megawatts of what type are assumed in each year, and then what's the cost of the resources that are assumed within that. So we had both things change, and we updated in our 2022 capital plan to align with our latest understanding of the market in terms of costs for new renewables, and also an updated resource plan that was identified through our integrated resource planning process, or our IRP. I'll say IRP throughout the rest of this just for brevity, but wanted to make sure that everybody knows what that stands for, because I can throw out that acronym with abandon at times. So on the next slide, we'll highlight the specific benefits associated with these new renewables as identified through the IRP process. So David talked a little bit about this in response to questions earlier, but when we think about an IRP, essentially what it's doing is a 20-year model that's looking at the cost to meet customers' energy and capacity needs. So you have a capacity need, which is driven by your forecasted load, and then whatever SPP's planning reserve margin is. The combination of those two things generates your capacity requirement. So when we build an IRP, we're planning to meet that need in the long term, over 20 years. From an energy perspective, with the way the SPP market works, it's more of an economics comparison of what's the most economic mix of energy sources compared to buying energy from the market and not having generation that is dispatched in different economic situations. So that's where we try to turn it all into a revenue requirement number. And that's supposed to be an all-in assessment of customer costs. So it's the capital costs of new resources, the operating costs of all resources. What's our expectation around market price, SPP market prices for energy, and how much we're going to have to pay to purchase energy to serve our load. What's our fuel cost under a variety of different scenarios, which I'm sure we'll talk more about. So I always love to talk about different scenarios, especially given, can't remember what word we ended up with, but dynamic was the word we'd used a lot. There's also a more negative, volatile word that we could use. So we try to see everything across a variety of different scenarios. We calculate the revenue requirements for different resource plans, and then we create like a probability weighted value, which is an expected value of revenue requirements on a net present value basis. So all the numbers shown here are that expected value across several different scenarios. In this case, it would have been across 27 different scenarios. And these are the revenue requirement benefits only associated with these new renewables that we're talking about. So I'll walk you through the slide kind of from left to right with all of that as context on how an IRP works and what it's looking at. On the left-hand side is what was in our February 2021 capital plan. So that was about 500 megawatts. At that point, we hadn't incorporated those renewables kind of in that form into our IRP. So there weren't any calculated savings yet at that point. They were supported by modeling done for the STP, but it hadn't been integrated in the IRP yet. So that's where the 2021 triennial filing of our IRP became so important. So in 2021, later in the year after that filing, we incorporated those 500 megawatts of solar, and then also identified through the IRP that there were benefits from adding additional wind in 25 and 26. That added up to about 1,200 megawatts of total new renewables. And the savings that were identified, again, on an expected value basis, because of the capacity that comes from those resources and the energy value they provide in the long term across a bunch of different scenarios, it was 340 million in customer savings across a 20-year period. Fast forward to the February 22 capital plan, we had started doing some procurement activities. And so we had up-to-date information on specific projects, and we had seen that basically the solar projects in the market were not as mature, and there was higher risk than the wind projects that were out and available. So we planned on a shift in the timing and a slight reduction in the overall amount of capacity that was going to be added. We subsequently incorporated that in our 2022 IRP, which was filed earlier this year, and that showed an additional $120 million in savings from that change. So overall, if you're comparing from a plan that has no new renewables in the next 4 or 5 years to this plan that's on the right-hand side, it was about $500 million in total customer savings on a net present value of revenue requirement basis. So that's a lot of numbers. I don't want to get too far into the math, but the fundamental thing that is provided by these renewables is both capacity and energy. Solar is going to have a slightly better capacity, or really sizably better capacity credit than wind, but it will have less energy. Wind, very good energy resource, not great from a capacity. So the IRP is supposed to be balancing those all-in costs and assessing the best mix of resources to meet both capacity and economic energy needs for the customers. On this next slide, I really just wanted to highlight this in the spirit of regional comparison, so you can see how our longer term resource plan, so this is through 2030, compares to some of our regional peers. The short story is we're a little less aggressive, a lot less aggressive than some of our regional peers in terms of the pace of a renewable investment at this time, other than OG&E. And I think Chair Keene made this point earlier. Everyone has a different fleet. Everyone has different access to renewables. So it's hard to compare these things kind of apples to apples. And so this is more just a data point to show kind of the scale of our renewables investment over time compared to other peers in the area. So with that, I'll jump to the next one, which really gets into kind of the bulk of where the discussion with David went earlier, and a lot of our focus as we go to execute on this resource plan. That in the IRP, we identified that it has, I don't really like this word, but has generic benefits. These are generic resources that we add in the IRP, but we have to go through the process of selecting actual projects with actual costs, actual performance, and looking for one that best meets up with what the IRP identified in terms of needs for those resources. But also, like the plan identified in the IRP is not set in stone. As I've shown, we already have updated it based on actual project information. And so we'll continue to do that as we go through this process. But as David mentioned, and there was some discussion of it earlier, in the IRP and in the capital plan, we currently assume that all new renewables are owned. There's some reasons for that from an IRP, like modeling technical standpoint, that are not as important. But the main reason for that is, as I'll highlight specifically on the next slide, our current renewable fleet is very heavily weighted towards power purchase agreements, or PPAs. So we think that as we lean towards renewables being an even larger part of our capacity mix, an even larger source of energy, it's important to balance that out and really focus on ownership options and not just PPAs, as we have to a large extent in the past. Not always, but as David highlighted, we're vast majority of our current renewables are PPAs. With all that being said, we know we have to evaluate both. This whole process will be designed to evaluate both and try to get as much of an apples to apples comparison between ownership and PPA options for actual renewable projects before we go to procure those resources and actually add them to our resource mix. So we started a process a couple months ago to develop a new RFP, or request for proposal, where we'll ask for both ownership and PPA options for new renewables. The main benefit of this is, one, it lets us factor in the results of the IRA, or the impacts of the IRA on renewables. So we'll see kind of the balance between supply chain pressures driving up costs, the IRA bringing down costs, kind of see how much of that benefit from the IRA is really getting passed on directly to us as the buyer, and then to customers ultimately. So we'll do that. And then we'll also gather new information on kind of what's the best risk-adjusted comparison between PPAs and ownership. I think there was some discussion earlier about, given a very dynamic world, like, isn't it a safer bet maybe to lease your generation as opposed to buying new generation? What we'll try to factor in is sort of that long-term trade-off of, yes, PPAs are shorter term, but they're still pretty long-term, generally 15 to 20 years, and you're locking in a fixed price for that asset over the long term. And the reason that those are sometimes cheaper on a per megawatt hour basis is because the developer who owns the farm is baking in a lot of option value at the end of the contract. And so they have the value to go take that farm merchant in the long term where they might expect market prices to be significantly higher. They could do something else. They could repower the site. They could sell it again. There's all kinds of option value that the developer has if they offer us a PPA, in which we lose under that construct. On the flip side, with ownership, we maintain all of that optionality. So it is both a longer term option, but it also preserves more options for the long term to make that kind of on both sides for ownership and PPAs. So we're going to try and factor in as many of those considerations through this RFP process as we possibly can, so we can see what's the potential value of this site in the long term, what is the risk of letting this interconnect go, for example, if the developer maintains the interconnect in the long term, and finally, how does all of that impact the levelized cost of these resources and how do they compare to each other on a more direct basis? So it'll be a long process. We'll work through it in the first quarter, start doing the RFP itself and getting those results and reviewing them, all to support our upcoming 2023 annual updates so we can have a more up-to-date view of the market, given the IRA and everything that's changed. So I'll do one more slide in this section, just to highlight, I've captured most of this, so I won't spend a ton of time on this slide, but the left-hand side does highlight what David alluded to and what I've mentioned now is that our current renewable PPA fleet is, if you project it forward to 2027, would be almost a quarter of our nameplate generation fleet, which is a significant portion of our fleet that would be not under the direct oversight of this commission, not under the ownership of us as a local utility. Like we would just not have the same level of control over those resources. If you look at the new renewables in the IRP today, that's another 9% that could go, as David mentioned, either way, a mix of ownership or PPA, or it could be all one or the other. But regardless, it will drive that difference or that portion that is not under the control of us or under the oversight of this commission. So I think I'll wrap up this section. I know folks will probably have questions, but just wanted to highlight that we're going through this process to evaluate everything and to ultimately come to a mix of ownership and PPA through the RFP process, informed by knowledge of actual projects and the risks and the long-term value of each of them. So that I'll switch to existing generation. So this is a little bit simpler in that I think we're all familiar with the investments in our fossil renewables nuclear fleet. And overall, we've had a pretty slight increase over the time frame. A lot of that was really targeted investments after Winter Storm Uri in resiliency for kind of sustained cold weather periods. So a lot of the change in 22 to 25 was associated with that. And then for 2021 versus 26, as I mentioned, we actually had a pretty good reduction in generation spend for our existing fleet over that time. The next slide highlights the two ways that we try to think about this investment. And it's always a balance between these two kind of key metrics as they relate to our generation fleet. The left-hand side is something we call commercial availability. The way that we try to use this is as a measure of how well the plants are performing from a reliability perspective when they're needed by the market. So it's sort of an evolution of more traditional metrics like equipment availability, because it factors in whether the unit was called for by the market based on the pricing in the SPP market at that time. So as you can see, we've held that pretty steady over the last few years. With the higher natural gas price environment today in particular, this metric has become even more important because you're seeing significant price volatility where the cost of unreliability or unavailability is more significant in a high price environment. That's why we focus on that on the left-hand side as our kind of measure of reliability. On the right-hand side is sort of the longer term view of, yes, it's critical we maintain reliability, particularly when the market needs the resources, but we also have to manage down the net asset value of these plants towards their eventual retirement. So we do that by tracking our spend as a % of our annual depreciation expense. As you can see, even with some of the increases we saw 22 through 25, we're well below depreciation, annual depreciation, and we're as low as like a third to half of our annual depreciation that's getting invested from a maintenance capital perspective. So this is our ongoing balance. As you saw, the increase or the change really between the two capital plans was fairly minor, but it is showing that we've made a specific focus on investing in resiliency and reliability, particularly in today's high gas price environment, but also keeping that focus on maintaining the long-term asset value and managing that value we have to deal with at the end of life for the plant, managing that down over time. So with that, I'm going to hang out here for a second. We don't have a great divider slide, but that is the end of my section. I think we're going to pause for questions here. I'll turn it over to Chair King for that.
Well, thank you very much, Kayla, for that presentation. If we could take down the slides here. Very good. Well, let's turn for questions first to the KCC staff. And again, I'll turn back to Jeff McClanahan.
Well, thank you, Kayla. I appreciate that. I don't have any questions at this point. Justin, do you?
Jeff, no, I don't have any questions for this section. Thank you. Thank you, Kayla.
Leo?
I have one, Kayla, and that is, you mentioned, I think, to Joe Astrap's question about the effective load carrying capability for solar being at 50%. How does your model account for the solar capability in the wintertime? So that seems like a summer number.
Yes, that is a summer number. Good question, Leo. So historically, the IRP is focused on meeting summer capacity requirements. So when we build the resource plan, it's all built around summer, and we're looking just at the summer accreditation for those resources. SPP is in a process right now of really refining the winter capacity requirements, and there's a lot of unanswered questions still. One thing that's pretty certain is that solar will get less credit in the winter. What we've seen is if it's 50% in the summer, it might be as low as 10% in the winter. To date, we haven't incorporated that directly in the IRP. We try to do sensitivities to see where it might go. But until we have more specific rules from SPP on how they're going to treat natural gas generation in the winter, what the actual reserve margin will look like compared to the summer reserve margin, we just haven't been able to mathematically factor that in quite yet.
Does that pose a risk for you guys, or is it covered because you have capability from other facilities that would cover that capacity need?
Yeah, traditionally in the winter, we've had lots of excess capacity just based on how particularly for Kansas Central, how the fleet is and what the differential between summer and winter peak is for Kansas Central. So it hasn't been a major risk in the past. It's something we'll have to look at, and the big question mark, like I said, is natural gas. What do you have to assume? What do you assume the requirements are to accredit natural gas in terms of fuel supply availability or firmness of fuel?
Thank you. That's the only question I have.
Okay.
All right, thank you. Curb questions, Mr. Astrup.
Yes, thank you, Chair Keen. Good afternoon, Ms. Messamore. I want to talk with you about kind of generally with these increased investments with renewable energy at this time. As some people may know, Evergy is coming off a rate moratorium from the merger at the end of next year. And so what factors or conditions has Evergy identified that kind of has led them to make this decision to invest in renewables at this level and invest at transmission and distribution at these levels currently? What are some, can you get some more like color behind all that?
Sure. Yeah, I can cover some of that. I won't steal Bruce and Steve's thunder
Sure.
entirely.
I figured it might go over there too, but
yeah. But yeah, from a renewables perspective, the things that have changed are, well, most recently, we've seen the elevation of market prices with natural gas going so much higher than we had seen for a while. All of that does is increase the value of energy provided by renewables, particularly because they are zero or negative variable cost, depending on tax credits. So that's one thing that has driven the change. The other is just continued advancement of the technology over time. As we've seen recently, supply chain pressures have sort of counteracted what we had seen in terms of technology costs declining. But overall, they have declined to a sufficient level. They're economic from an energy perspective, and they do provide valuable capacity with the way SPP has tightened those requirements, even if it's not 100% capacity credit. The capacity is still valuable and the capacity is still needed. And these are a very economic source of meeting that need. So I wouldn't say there's something like one trigger event that happens and now all of a sudden it makes sense. One thing that hasn't happened in the past, or we didn't have a Kansas IRP framework until 2021 was the first time we filed under that framework. So it's been great to be able to bring that long-term view, which wasn't available because there wasn't that sort of process. It was handled differently in the past, but the IRP does allow you to do robust scenario analysis, look at a comprehensive resource plan, and really factor in all the different inputs and costs that go with a resource plan to evaluate what's most economic.
Thank you for that. I appreciate it. Just kind of dovetailing off of that discussion about the IRP and accreditation and everything too. Traditionally, it seems like renewable generation up to this point has been accredited a lot lower than levels of like coal and gas as far as that goes. And so over the years in the various reports, seems like Evergy's been experiencing pretty low to slow customer growth and load growth. And so is there anything that's going to be changing in those metrics in regards to growth that adding renewables will somehow account for, especially as the IRP becomes clearer when it determines more details behind plant and coal retirements? How does that all going to end? Is there any sort of details you can provide behind Evergy's projections, leading to our next year's IRP and CIP presentations?
Yes, there are several questions in there.
I'm sorry. Yeah. Feel free to break it down then. Yeah.
Yeah. So from a load growth perspective, I mean, while base load growth has stayed fairly consistent, we do have things like Panasonic and other economic development activities that are driving significant growth in our forecasted load. So we do have to incorporate those into our IRP and come up with the best way to meet those from both a capacity and an energy perspective. So we're going to have to balance both of those things. You also, with economic development, have to factor in whether those specific customers are looking for renewables or to what extent they're looking for renewables. So that's also a balance that we'll have to look at through both the IRP and ultimately rate design with any new customers. So that's one thing on the load side. From the other driver is that SPP, like we mentioned, increased the reserve margin from 12 to 15% starting next summer. They've hint is too weak a word for what they've done. They have implied that they will continue to increase the reserve margin in the future. They've also said they're tightening accreditation for thermal resources. They've been tightening accreditation for demand side resources. They're tightening accreditation for renewables. All of these things together, the increasing load, the more stringent capacity requirements, are driving a need for more capacity. So it's just a completely different framework than we operated in for several years of having excess capacity compared to what SPP required. I will say that's not the case anymore. It's not going to be the case going forward as we have these large new loads come in. So a big focus is looking at renewables that provide low cost energy. They provide some capacity. And then also looking at what do we need some more pure capacity options that provide a higher level of accreditation, maybe less energy, but balance out that fleet, balance out that portfolio to meet the increasing requirements.
Thank you for that.
And did I miss any parts of your question?
No, I think that's good. I'll talk about coal retirements later, but I kind of want to talk more about capacity requirements and everything too. I know you talked a lot about PPAs versus ownership of renewable generation, and I've read fairly recently that the SPP and its open access transmission tariff allows for anybody who wants to sign on and contribute to the marketplace that can do that. And there's been a lot of development with wind projects from the private side. And so could you tell us a little bit more about your analysis regarding the benefits between ownership of renewable generation and pursuing more PPAs in light of this environment in Kansas?
Yeah, I can highlight some of it, and then Jason Humphrey is here as well, and he leads our development efforts, so he can probably add on.
Okay.
But like I said, we're starting an RFP process, and the main goal in that is to capture, to the greatest extent possible, the true cost of both resources. So when you think about a PPA, typically generally they can get a lower cost per megawatt hour because they're more highly leveraged. Like I said, there's option value on the end that the developer is maintaining, where they say, well, I'm gonna make this money after the contract's over, so I can bake in a little bit less cost early on in the project. So those are the types of things we're trying to capture. And so we can compare these projects on a more apples to apples basis. But I will say the evaluation is starting now. I mean, we've done it in the past, and we've filed, for example, the predetermination case included some evaluation of PPAs versus ownership for that site that we ultimately withdrew for the reasons that David mentioned around supply chain pressure. But that's an example of how that evaluation works. We're always trying to make sure it's getting better, and we're open to any suggestions on how to evaluate that. But that is what we're planning to do. Jason, do you want to add anything? Jason is going to add something.
Oh, okay.
I can hear him. One
Fair
second.
enough.
If the host could give me permission to turn on my video, that would be great.
Jason, I think we can hear you.
Okay, I won't worry about the video. Sorry about that. I think Kayla covered a lot of the issues surrounding PPAs versus ownership quite well. But Evergy's had a different experience here in the last couple of years with PPAs than it had historically. In fact, in 2021, we actually had 2 developers walk away from projects. And so even our risk of delivery certainty has changed. That was augmented by the supply chain pressures that we've seen, the energy environment and labor environment in 2021. And so as we get ready for this 2023 RFP, we're really looking at all of the ways that this PPA versus ownership choice impacts customers. Kayla's slides that she went through earlier showed a large net present value of the revenue requirement savings for the addition of these renewables. But as we choose specific projects, that's all going to be done within the context of a specific request for proposal for these new energy resources. And that'll give us the option to evaluate resource addition A, which may be owned, versus resource addition B, which may be contracted for or leased through a PPA. And just like we did in the predetermination docket that was subsequently polled, we'll evaluate those options and see what we feel has the best long-term benefit for our customers. Because while the IRP looks at a 20-year time horizon, those assets that Evergy has owned for years and years and years have benefited customers as a hedge to the overall market. And that's something that we get through ownership, and that's some optionality we would like to preserve. It's going to be a balance, as David said earlier, but we want to evaluate those specific risk points as we make incremental resource decisions going forward.
Thank you, Jason. Excuse me. I appreciate the extra details there. I guess more specifically, could you speak also about kind of the comparative returns on investments between ownership and renewable generation versus entering the PPAs? Is there any sort of distinguished differences there as far as that topic goes?
Yeah, I mean, they're treated very differently from a rate perspective. So any of the PPAs that we have, or that if we signed any in the future, they would flow through the RECA, the fuel adjustment clause, whereas the owned option would go through base rates. It would be in rate base like any of the other investments that we're talking about today. So they're treated very differently. Obviously, there's a return included with what goes into rate base if it's an owned option. But it's a very different ownership structure. The risk is borne. What's interesting with the PPA is that it's a long-term contract where this developer is somewhat taking credit for our strong balance sheet, and we're not really getting compensated for that value that we're providing. So that's where we've used things like an imputed debt adder in comparisons in the past. So that's the kind of thing that we're trying to compare, but they are treated very differently from a rate perspective.
Thank you for that.
The energy cost that will flow through the fuel clause will be much lower for known renewable because you're not paying to the PPA. So it's a different, if you will, even if they're the equivalent cost from a levelized cost of energy, it will just be a different profile as to where it flows through, if that makes sense. Because the PPA, it's all going to be embedded in what's flowing through the fuel clause. Be a much lower amount through the fuel clause for an own renewable, but it'll be in the capital base. So it's a little bit of a different profile, but often the underlying impact on the customer will be very similar.
Okay.
And the only thing I'd also add is most of the entities that own that our counterparties in PPAs are highly leveraged special purpose entities. So they add a lot of leverage because they're got a long-term contract with us. So that ultimately is going to drive up costs because they're using our balance sheet, but those are sort of unregulated special purpose entities that have much higher levels of debt that of course we would be allowed to have. And having that direct oversight and having a mix is, I think you've just heard that term over, is that we think there are benefits to having that mix of owned versus PPAs. And up to this point, we've not really had that balance. We've had it heavily weighted to PPAs.
Thank you all for that. I appreciate it. I think the last point I want to talk about is the Panasonic plan. I know we've heard about the potential benefits related to the growth of that, but what kind of negative implications or additional costs coming to residential customers and other customers does Evergy possibly foresee with the Panasonic plan, such as through special economic development contracts, those kind of things? Build a new infrastructure to accommodate the load, any of those factors that Evergy has accounted for in their capital investment plans?
So the Panasonic impact is not yet in our capital plan. I think it will flow through. It'll probably be one of those dynamic elements. Sorry to use that term again, that flows through next year as we get even more specifics around their load requirements. So it may not even be what we show next year, but I think a portion of it will. A lot of those costs will be offset by the incremental load. There will be some transmission level requirements, but we're factoring in as we think about it. As you know, there was a legislative initiative in support of the Panasonic program. So that's a big part of the biggest part of the benefits they're getting are through that structure. It's not through their electric rates, but I do think that it's the amount of growth, because unlike a data center, for example, which has a lot of construction jobs and a lot of long-term jobs, the battery plant's going to bring a lot of incremental customers because there'll be that many incremental jobs. So I think that kind of growth net is a benefit for our broader customer base over time, because it just allows you better spreading your fixed costs. There'll be some incremental costs here. It's not all quantified yet as we see their projections, but that kind of growth is generally beneficial for the overall customer base because the amount of jobs and knock-on growth it brings, it just allows better efficiency overall in the system.
Okay, thank you. And I guess I kind of lied about being my last question, but you do bring up the point that, you know, these changes are pretty recent and new, and they came about pretty quickly. So as far as expectations for future projects like the Panasonic plan or other interconnectivity changes with the SPP, are there any of those built into the current capital investment planning or the IRP planning process going forward, or is it just kind of a reactionary type analysis at this point?
Yeah, I'm trying to make sure I answer
Sure.
the question you're asking. So in the IRP, we do have assumed levels of load growth. So that sort of base level of load growth is built into the plan. Things like Panasonic are over and above that sort of base level of load growth. So we don't tend to build those in until we have a relatively high level of certainty, because you don't want to be building for an uncertain future load. It will be a balance as we go forward, especially when you're thinking about loads of a size that require potentially large new generation that takes time to build. So that's one where we'll have to work with stakeholders on what assumptions we're making, so everyone understands that even if we're assuming some incremental load over our typical base economically driven load forecast, everybody knows what it is, and we can at least talk through that in the IRP process going forward.
And I'll state it in an aspirational way as well. It is reactionary. We have a baseline, as Kayla described, and we react to big projects. I'm hopeful and optimistic that because Kansas is so well competitively positioned, we'll see more battery plants. We'll see some ammonia production, green ammonia. We'll see some hydrogen production. So I hope that we're going to see more of this kind of thing because of the resource potential of our state. So it will react to that as it comes, but I really do think we'll have the opportunity for that. And that's a kind of beneficial growth that helps from a rate perspective overall. So I'm optimistic we'll see that.
Great. Thank you all both so much. That's all the questions I have for now in this section.
All right, thank you. Let's see if we have commissioner questions. I'll begin first with Commissioner Duffy.
Thank you. Hi, Kayla. So in terms of, we just talked about beneficial growth in terms of like new economic development coming into the state. And I do believe that I look at Oklahoma. I think they've kind of transformed themselves in the last 7 years. And it used to be Okie, Oklahoma. It's not anymore. They're a very vibrant state. Arkansas is. We've got a lot of competition. So I would agree with you, whatever we can do on the EcoDevo front to bring in manufacturing, whatever it is, that it will benefit us in terms of load growth. But where else do you see load growth? Are you looking at, and my question to you, what is the impact that EVs will have on this capital investment process? Is that even at this point in Kansas, is that a consideration into load growth?
Yes. So all 3 levels of load growth that we look at in the IRP include a different EV adoption scenario. So our mid load growth that we use in the IRP assumes a mid EV growth forecast. So we do have a base level of EV growth that's factored in to what we're assuming. Some other things that we've done, we've looked at broader electrification to see what impact that would have on the load growth. We're not planning around like building for full economy-wide electrification, but we have started doing studies to at least evaluate what that would look like. One thing we're doing right now is looking at trying to take an electric vehicle forecast down to a more granular level so we can see geographically where we expect it might start impacting our system. So we've looked at it in aggregate for years. We update that forecast whenever we do a load forecast, we update our EV forecast as well. But what's more critical is how are we looking at pockets where we might see faster adoption of EVs that are going to impact the distribution system first before they impact the broader kind of generation supply mix. So that's a different part of what I do, the distribution side of what we do. But we are looking at how do we get that circuit level EV forecast, and how are we making sure when we prioritize capital projects, at least potential for electrification in a hotspot is a factor in what we're looking at. That's pretty early stages, but that's how we're trying to look at it, is find the areas where it might hit first in terms of localized impact, and then also keep our load forecast updated in aggregate.
So what year do you find that? And I see Mr. Casely's joined us. What year do you find where it's going to be a pow effect, like EV will really have an impact?
Well, this is like a SMR being 10 years out for 15 years. This is the mystery of the hockey stick. Chuck, you're making an echo. Sorry.
That's okay.
We're sitting too close to each other. So no, I think we've been planning around expecting that hockey stick in the 5 to 10 year window. So we're doing everything we can to like prepare all of our systems, prepare our processes so that we're ready to enable that in the future and not get in the way of it. I don't know. We'll see if it actually materializes as a hockey stick. That's what everyone has always expected it will do, but the hockey stick keeps moving out. So that's what we keep an eye on. We are thinking in the 5 to 10. Chuck, you want to add anything?
I was just going to add that one of the advantages of the clean charge network and having more than 1,500 different places that we have access to who's charging and when, where they're going, and then being able to map them back to their house is that we've probably got a little bit better granularity of vision and view on where electric vehicles are really developing, what neighborhoods, and that will all feed into the future and also help us to anticipate as we're in this hockey stick adoption period where it's likely to impact first. And that's just part of having that clean charge network where we have 1,200 to 1,500 different places charging every single day. Again, we know who and where and how long and what the effects are on the system.
Okay.
I'll stick my neck out more if I may, Commissioner Duffy, on that. Is that to say, I in this plan that we have 22 to 26, it's really not a material driver.
Okay.
EV adoption. I do think if we're sitting here 5 years from now, we're looking at 27 to 32. It is going to be a material driver. So I think the back half of this decade, given the number of new EVs that the manufacturers are putting out, we're really going to see it. And it's going to be primarily Johnson County and Sedgwick County and Shawnee and Douglas County. So it's going to be localized in terms of the impacts on the distribution system. And a lot of the charging will be at night, so it'll be reasonably complimentary, but I think it's really the back part of this decade and it really makes a material impact on the capital plan. Might be wrong in that if there's an earlier adoption, but that's, I think, our best guess.
Okay, thank you for adding that. That was very helpful. Okay, so Kayla, in terms of the congestion that is happening currently and the kerfuffle in the queue with SPP, how is that actually impacting your ability to look at this CapEx spending and actually have it materialize?
Okay, first of all, I appreciate the kerfuffle in the queue, and I think I might adopt that because the alliteration was fun. So I got distracted by that for a second. But yes, I think what we're seeing in terms of congestion and with the backlog in the queue, that's where we're very supportive of what SPP is doing. One, to clear the backlog, but also to develop a more sustainable long-term cost allocation framework. That's what's to a certain extent driving the backlog, because you have these new generators that are sparking these huge upgrades that they can't cover on their own. It just ruins the economics of their project. So that's where we're spending most of our time with SPP, is thinking about how do we fix that sort of fundamental problem, as opposed to just like forcing us to go through the queue as fast as possible. It's the underlying issue is more of a cost allocation one than it is a kind of technical backlog. With that being said, I think we have seen delays because of the backlog in the queue. That's part of why we've slowed the pace in our more recent IRPs in terms of scale of how many megawatts, what type, switching the wind and solar around, just based on what is available with a favorable queue position that's likely to get done in time. So we try to factor it in terms of what's achievable, but what has to happen is that we have to fix sort of the underlying problem. I know that Commissioner French gets to participate in the consolidated planning process task force discussions, which are all great, and I do have high hopes for them, but we really need to see that through so that we don't just continue to have this backlog that builds and it slows down everyone's ability to execute on necessary beneficial renewables.
I would agree. I think we'll all benefit, but I also don't think this is going to be like short-term solved. I mean, even though we have, I think everyone's frustrated, it doesn't mean we're all going to be able to resolve this issue anytime soon in an equitable manner. Therefore, I'm just, as we look at your capital plan and the IRP, I just don't see some of these happening in the time frame that we would all like them to. And then couple that with, I believe, congestion. And I believe, David, you said this, it's a huge problem because it impacts cost of, and therefore, isn't that the more significant issue? I mean, I don't know that we can deal with both of them at the same time. At least SPP, when I said we, I think they have trouble dealing with all of these in a way that really, juggling all the balls up in the air at one time.
Right. Yeah, and I think the sort of parallel effort that SPP is doing is trying to make their economic models more realistic and match up to what is actually materializing in the resource mix. So as they make their economic models, which are the models they use to identify kind of congestion relieving projects, as they make those more realistic and they match up with actual resource plans, there's somewhat of a circular, it's a little bit circular, but it does benefit being able to get those resources in the end, because SPP knows they're coming and can start identifying projects that aren't ultimately assigned to the one individual wind site or solar site. They're looking at it more holistically from a congestion alleviation view.
Okay.
So right. I do think SPP is trying to tackle them both at the same time. You're right that it's a challenge to do them both. And that's where cost allocation is an important question. But they are at least sort of tackling both sides of it.
Okay. And back on page 31, when I look at the jump from year to year, whether it be savings or whether it capacity, there's just such, I mean, there, to me, it's quantum leaps. And in all realms. I mean, from one plan to the next, it's like they're very separate plans. I mean, you've got to connect the dots, I think, to really have an understanding. And I'm sure staff's got that well in hand, but it seems like sometimes I think different people put these together. Thank you, Chair Keen. Thank you, Kayla.
Thanks, Commissioner Duffy.
Thank you. Commissioner French.
Thank you. Well, hi, Kayla. I'll just be really brief because Mr. Astrab and Commissioner Duffy already got you talking about all my favorite, passionate issues. I mean, I'm just going to say, I think it is not a bad thing that we have great prospects for economic development here in the state of Kansas and more to come. We just have to figure out how to support that. We never want to lose any opportunities. And so, you talked about all the challenges there that, not only energy, but probably much more importantly, capacity. We've got tightening capacity reserves throughout the region. Our region is, not alone in that. But it is certainly something we're going to stay on top of to make sure that we get as much growth as we can possibly get, because for all the reasons to invest, that's the one you want to invest for growth, because that benefits everybody. So I'm going to leave it there. Maybe I'll just, because they got you talking about those issues, let me ask a little more granular question. On your last, I think it was your last slide, 36, you talked about investments you're making at your plants to improve their availability to the market. And I think what you're referencing there is specifically making sure they're available when there are opportunities to make sales into the market and to make revenue. But we also know, there's new market constructs being talked about in SPP. There's a new ramp product. There's a new market uncertainty product. I think there's even been discussion of creating what the market monitor has called an availability product. That would help. I mean, from my perspective, it might help offset some costs that customers bear for keeping plants at the ready and supporting reliability in the region, even if we aren't asking those plants to run minute to minute. Could you just talk a little bit more about opportunities you might see there? Do you think there's opportunities for improved market products or other mechanisms? And do you think these investments can help you capitalize on those products?
Okay, there's a lot there. I will attempt, and then John Britson is sitting next to me, so he might get to add on a little bit. So specifically with those new ancillary products that you're talking about, the ramp and the uncertainty product, those are less coal focused. They're usually shorter time frame, more gas, quick start, quick ramp, that sort of resource. We're always looking to improve the flexibility of our coal fleet, but it's just, they're less of a focus in something that's so intra-hour centric like those uncertainty products. I think the big question on things like what the MMU is proposing for an availability product and all of these other things is, like, will it really reward the coal and nuclear fleet for what they're offering, which is consistently available, secure fuel supply, all of these things that they offer. They won't get to the point of a quick start gas unit in terms of ramping and coming online and all that, but they do provide that secure capacity. So I think these investments that we're making, some of them improve flexibility, but it's generally making sure that when the market does call on them for energy, primarily, are they going to be available? And that becomes even more important with performance-based accreditation, because that is just a traditional E4 forced outage rate driven calculation. So that, regardless of whether, although the market is kind of factored into the calculation, that will become another sort of side of while it's not necessarily an incentive, it is a stick if you don't perform, if you're not reliable, and if you're not investing to keep the plant reliable.
Are these investments redundant to, or I guess, is there overlap between these investments and the ones I think you referenced in an earlier slide of, additional weatherization and other things at the plants, perhaps to improve your performance-based accreditation? I mean, are they kind of the same items, or are they a little different?
Yeah, they're all one and the same. Some of the specific things I mentioned were like winter resiliency. So that's weatherizing certain parts of the plant that we had some lessons learned from Uri. So some of those are pretty specific, and it's just like a couple of focused projects on winter resiliency. But across the board, it's one, weatherizing, making sure everything is prepared, even for those extremes, to your point, to help with performance-based accreditation, but also just general equipment availability, making sure we're using the data we have to do predictive maintenance on equipment before it fails, before it takes the unit down when the market has called it. We're fixing it when it's not in the money, so to speak. Sean, anything you want to add?
Oh, go ahead.
There's nothing.
Okay, John says he's good, and also he's not allowed to unmute himself. So at a later point, if he needs to say something, we will have to correct that issue. But sorry, go ahead, Commissioner French.
I guess that just a little follow up to that. The size of the investments, the weatherization, the operational improvements, were those just sort of no brainers given the cost of capacity, or was there any sort of cost benefit analysis of, if we make these investments, we won't have to build, new capacity, or we'll have to build less or smaller capacity? I mean, what was sort of your analysis in making those investments?
Yeah, we do for what we'll call like reliability or performance or kind of risk-based projects. We do cost benefit analysis associated with them that's more focused on energy. So it's what's the risk of this unit coming down because of this piece of equipment we're replacing versus what's the cost to fix it and keep it from coming down. So it's a little more energy focused. We haven't looked at that many, well, given the uncertainty around performance-based accreditation, how it's going to be implemented specifically in the UCAP versus ICAP and where the planning reserve margin is going to go. We haven't yet factored in that specific capacity value to these projects, but it will be doable. I just think that energy will probably be more of the driver still.
And you're saying from a energy from reliability standpoint, but also from a lost revenue standpoint, if it were to come down.
Right. That's what we're looking at, is the lost revenue potential if the unit comes down.
Okay. Yeah. I think that's it. I appreciate all the information. Thank you.
Thank you, Commissioner French. Well, Kayla, I've saved most of my questions for you. And so as to not be picking on you, I'd be happy to share, have you share that load with David too. So I'm going to direct my questions to both of you, and you can do a coin toss and decide whether either or neither of you want to answer these questions. I'm going to go in a little different direction than we've been heading in with this line of questioning toward you. I don't see this in a really critical way at all, but I thought missing within this section were charts or tables that would demonstrate the relative contribution of Evergy's various baseload fuel sources over the planning horizon, so we could kind of trace that in a very visual way. And by that, I mean rather specifically, and what the primary effects would be to the utilization of, or lack of utilization, of the non-intermittent and dispatchable, reliable and resilient coal and gas plants. So toward that end, I guess my first question is, what is Evergy's commitment to having a balanced portfolio of baseload fuels?
So I'll lead off on that, Chair Keen, and Kayla will supplement. As you know, she's got a lot of great expertise in this. So our view is that a balanced portfolio has been a key benefit to our customers, especially over the past year. And as I mentioned, having a relatively higher mix of coal in many of our peer companies did hurt us in the 2010s because heavy natural gas states, especially Oklahoma to the south, natural gas with fracking got very low cost and they got a price advantage. Now that's narrowed already significantly. We think a balanced portfolio going forward will continue to be of significant benefit for our customers. Now we'll be objective about how we evaluate that. So we want to evaluate that through the integrated resource plan with the best assumptions that we can have. And I think that the assumptions that we have in the integrated resource plan reflected the ongoing importance of coal. So our retirements are later than just about any of our regional peers in terms of timeline and progression. I suspect, and this is projecting, but with higher natural gas prices, very likely to be in the forecast for next year's integrated resource plan, that will continue to be the case. And as I mentioned, the Lawrence plant that we had been planning to retire of, John Britson and the team there have been very resilient about our moving the date. It's not an employee-friendly action to say, hey, we're going to be retiring your plant. Fortunately, we plan that we build off them spots to other places, but it creates a lot of uncertainty. But now we said we pushed it back a year, and I wouldn't be surprised if as part of the analysis next year, we push it back further. And that was our first plant on the bubble and our smallest one. I suspect it will continue to see coal in the mix. It's the end of this decade that we have the next big unit coming offline. We have some leases and other things that will come to play where it's not totally in our control, but that'll be a dialogue that we have with our commissions, both here and in Missouri. And I think that balanced generation mix is going to be very important because without it, we've seen the downsides with some other states that went big on gas of very big fuel cost recoveries, both in URI and cents. So we think a balanced mix makes sense. We think with the IRA, there'll be ongoing benefits for adding renewables that will lower cost to customers, but we're going to need the coal plants for reliability and capacity as well.
Thank you, Will. I think you suggested in the earlier segment, David, that you were taking, I think, the long view. I'm poorly paraphrasing you here, so excuse that. But you were taking a long view with respect to some of the input costs that affect you. All energy prices, including natural gas prices, are cyclical, aren't they not? They have a propensity to have troughs and peaks, and it appears that we're definitely in a peak cycle now. God only knows how long that's going to last, but we're certainly there. Is that a fair assessment?
I will not profess to be an expert on gas prices, other than I am a believer in the cycles. We sort of can convince ourselves that they'll be perennially high. We sort of all believe that in the late 2000s, and then in the 2010s, we sort of all convince ourselves they'll be perennially low. I think the reality of the cycle is what we see again. So we typically don't try to take a proprietary view on natural gas in our integrated resource plan. We use EIA, which has a pretty modest long-term gas price forecast. It's coming off of the peaks, but we use a high, medium, and low given the uncertainties that we'll find. I do tend to believe, as you expressed, that there will be a cycle going forward, and that's why a diverse generation mix makes sense. Because if you are going to cycle, and if all predictions are imperfect, but you're building 30 to 40 to 50-year assets, it's best to have a diverse mix, because in any given time, something's going to be in the money. Just think about Wolf Creek Nuclear Plant and the frowns versus smiles that are directed towards that plant over time. I think when all is said and done on that, we'll all be happy that we had it, in part because of the fact that there was that volatility and it was a very steady, consistent source. So I think that cyclicality you mentioned speaks to the benefits of fuel diversity in your generation mix.
I think that's a great response. I wasn't here at the time, but I'm told back in 2010, when some decisions were made about coal versus gas, we were going through one of these up cycles with gas again. So coal gets the nod, and then see what happens in the intervening period. The gas market fell down to $2, and it wasn't at 7 or 10 forever. So they are cycles, and I think you appreciate that very well. I'm going to push this a little bit further on the coal plant, and then I'll back off. At your current time horizon, what are your current plans for the retirement of the coal plants beyond Lawrence? What would be the outer date?
I think in our integrated resource plan, and Kayla, keep me honest on this, we've got a coal unit coming offline, I think in 29, another one in 31.
You're off by a year in both cases. So it's 30 and 32.
30 and 32. That's why I always benefit from being with the team. And then I think we have a series over the course of the 30s. From my perspective, Commissioner Green, not to be I mean, the integrated resource plan is critical. I do think we'll see those retirements. They're out of the 3-year cycle, so we'll have better information to get more precise around those dates as we approach them. We see a number of our peers who've committed to being out of coal by 2030. Some of our upper Midwest peers have made those kind of comments. We have not made those kind of projections. So our next ones being in 2030 and 2032. To me, the big wild cards are what kind of technology developments do we see on nuclear, for example? What kind of regulation do we see that may be impacting coal costs? Does carbon capture and sequestration play a role? That's what's going to drive, because once you get into the 2030s, 2040s, our IRP will say that we're going to still be operating a lot of coal. That's our best guess as of today. It'll be driven by some of those inputs in that time. But over the near term, the most important decision, which was around, are we going to retire Lawrence? We've signaled internally that, yes, we have an upgraded resource plan. We're not getting ahead of it, but we expect that there'll be good logic to try to keep that in line. And then it's just out of deference to the operating team, of course, because we've been investing in that plant with the expectation we retire it. Now we need to see, okay, there's some things that will require enough expenditure that we won't be able to push that out too far indefinitely, but I suspect we'll definitely push it out beyond 23.
Thank you for that. The NERC 2023 Winter Reliability Assessment Report was just recently released in November. It pretty much, as it projected and anticipated the 2023 winter, gave SPP some passing grades, said that the tissues have acceptable levels of power available. It didn't fare so well with MISO. And I know you operate a bit into the MISO area too, do you not? But at least you're on the perimeter of it.
Yeah, we're on the seam with MISO. We don't operate in MISO specifically.
Okay, thank you for that, Caleb. And I think one of the reasons, I think the main reason why MISO is more problematic and more highly vulnerable is the pace at which they have retired their coal plants. It's the pace at which they have gone to more intermittent sources. So my question to you is this: how does Evergy manage the pace of the transition from renewables away from thermal and fossil to assure that reliability and resilience are not compromised?
So I think, and I share your view. There's my prior company was a merchant company that retired a lot of coal, and Illinois, for example, is simply an economic choice. It wasn't making money, and the capacity call was not that company's call, and that had to be assessed at a market level. And now it's the collective impact of those decisions has led to a little more challenge. So when we look at those questions, it's exactly the kind of inputs that Kayla described in the integrated resource plan. So we want to understand from a long-term perspective, where do we see our demand trending? Where do we see our capacity requirements? And we have to be prudent in how we approach retirements in light of making sure that we can keep meeting capacity needs. And it complicates things when the goalposts get moved. So the changing the capacity requirements due to sort of moving the numbers and changing the accreditation, moves the capacity requirement more quickly than you can actually move your generation. So I'm hopeful that there aren't too many more steps like that. But we have a reserve margin requirement in the context of SPP. So we analyze our situation relative to where we stand relative to that requirement. And that's a key input to our integrated resource plan. And as Kayla described, we'd been in a context of excess capacity for many years. And I think all of us, I imagine the commissioner, you all as commissioners may have a similar view. It's all of a sudden this capacity constraint sort of crept up on us, and we're all now in a different environment. So we need to be thinking about capacity additions in a way we didn't have to before, where before was just a trade-off of, can I replace a higher cost of energy with a newer, lower cost of energy? Well, now we've got to factor in capacity, and our consideration retirements has to be part of that mix. So you can't move too fast. I will not be surprised if coal to gas conversion is something we continue to look at over time. Again, as we look at, there are a couple of our sites that have some capability with gas. We could even look at adding to gas capacity. It's not the most efficient way to convert gas to electricity, but it leverages existing infrastructure, maybe more sensible than building something new. But I tend to view that over time, if either by mandate or for savings reasons, more coal is retired. And again, I think we'll have time to evaluate that. We'll need some peaking capacity in some form, most likely gas.
Thank you so much. Very, very granular answer. I appreciate that, David. Cost allocation within the Southwest Power Pool is a major concern for me. I think it's something we all share. We all want to make sure that we don't come out on the short end of that. SPP, of course, is our grid operator. And within SPP, Kansas, and in large part, Kansas ratepayers through Evergy, provide a lot of at-the-ready, non-intermittent, dispatchable, and thermal energy resources to the 14 states that are within the SPP footprint. This is done through, I think, these coal plants that you have, gas plants. We have the only nuclear plant, I believe I'm correct on that, within the 14 state SPP footprint. That being said, my question really is this, and I think it's kind of a difficult, and it is definitely a leading question. So I've given you some warning here, but I'm really concerned about this. My question is Evergy and our ratepayers, Kansas ratepayers through Evergy, being adequately compensated through SPP for the availability and the reliability that the substantial capital investment in these at-the-ready facilities provide to SPP and the other states? My sense is that we probably are not.
So that it's an interesting question. It's partly what's adequately compensated mean. I think as of now, with the tightening capacity requirements, we're actually even in. So one way to look at it is say, well, are we providing a lot of excess capacity in the market today? That margin was pretty high 5 years ago. It's a lot narrower now, in part because we had a lot of wind, that accreditation lowered, in part because we've seen some load growth. So the providing more benefit than we receive in terms of having excess capacity for the market within the next couple of years, that answer will be we are not providing excess capacity. We're using it all for ourselves. So I think that's a little more in the rearview mirror than in front of the windshield. I think that, see Commissioner French nodding, I think we're seeing that data. So I think that from that perspective, we are in balance, if you will, relative to others in our perspective. And I think there's one other nuclear plant, only one. I think it's operated by NPPD, the Nebraska Public Power District, but that's the only other one in SPP because there was an additional one in Nebraska that closed. But so I think we're balanced on the capacity side. It's congestion, as Commissioner Duffy mentioned, is a very important issue for us, especially being on the eastern edge with Kansas City, and our Missouri customers are on the eastern edge of the system, and we tend to watch that congestion very closely and carefully. I do think that SPP is, and with a shock, if you will, of higher market prices, has gotten better at managing it over the course of the most recent months, but it's still something to manage. I think that's something we're going to want to watch. It can benefit some of the Kansas Central and Western Kansas customers, though, that you have jurisdiction over, because some of that bottled up power is leading to very low prices for some of those load areas. So I think that I think it's a shared challenge at SPP as opposed to a unique Kansas challenge with respect to SPP. So I think SPP, we as the biggest investor-owned utility in the pool, need to help SPP think about how do they look forward in managing congestion and managing transmission in the context of more and more renewables coming in, which I think is going to happen with the incentives of the IRA, and I think it'd be done beneficially for our customers. But there's almost nothing more complicated than transmission planning and siting. When you're planning for something that takes 5 to 10 years to do, when decisions are uncertain, it's one of the harder things to do. But I think high involvement of our company, of this commission, other entities in Kansas will only benefit SPP, and it's critically important for us and our customers, given that we're right in the middle of the pool, and we're a big portion of the cost. If we were about 20% of the load, so we bear about 20% of the cost typically. So I'm not trying to give anyone a pass. I do think on that measure of capacity, we are about even now, so there's not a free riding dynamic. And I do think that I think we want to work with SPP and being as proactive as possible in how they think about transmission planning. That will benefit our state and our customers. And they're going to need our input and our help, our collectively, and not our company, but not just our company, but this commission and other players in Kansas.
All right. I appreciate both of you for your answers and your patience with my questions. I have a follow-on that's related to the transmission. I'll wait until the next section and ask that question. That concludes my questions. So thank you very much, Kayla. We appreciate your being here and your information. It's very helpful. David, I'll turn back to you, and you may direct it to the next participant.
Terrific. Well, I will now hand it off to Bruce Aiken, who oversees our transmission and distribution group. So the largest single organization in our company. And Bruce will give an overview and also talk about distribution in particular. Bruce, over to you.
All right. Thank you, David. Get the slides back up here. We should be on slide 37. Give it just a moment. There we go. So national utilities are dealing with aging infrastructure that was constructed decades ago, but has served our customers well. However, as our system is aging, it's time to increase our investment so that we can reliably serve our customers for decades to come. Further putting pressure on our aging infrastructure is an increase in severe weather. While it may not be considered severe in Kansas, this year we've experienced a nearly 50% increase in the number of days with wind gusts over 40 miles an hour. And there's a bit of a cumulative effect on our system from that. One day here or there isn't the same effect as having multiple days in a row. And we were seeing that this year relative to the last 5-year average. You might recall a year ago this week, we had a significant wind event that covered the state of Kansas, certainly covered our service territory from northwest to southeast that resulted in tens of thousands of customer outages that took multiple days to get restored. As we rebuild our system, we are building it so that it is more resilient to continue to serve our customers. Example of that resiliency, the transmission investments that we've made in the last few years, all the lines that we had reinvested in survived that storm and stayed in service. The older lines that we haven't gotten to yet, they suffered outages across our system. So there's definitely a benefit in that kind of a weather event that our system is much more resilient. In addition, we're seeing large scale, or they got the potential for large scale renewables and customer owned resources coming onto our grid, and we must continue to invest so that it can be flexible to meet the demands of those supply resources and the changes that come from that. And lastly, the amount of new technology that is now available on the T&D system allows us to be smarter about how the system operates and better in how we manage the grid. Moving on to slide 38. The information on this slide was compiled earlier this year by UMS Group, who has reviewed our grid modernization efforts. UMS provided testimony to this commission back in 2015 in support of our distribution modernization efforts at that time. The bottom line from this chart is that we expect modest improvements in reliability from our investments, but if we don't invest in our system as it ages, we're going to see a degradation in reliability for our customers. Moving on to slide 39. Now we're focusing on distribution specifically. As David mentioned, we heard the concerns about reliability and that we were not investing enough in distribution. As you can see on this slide, our 2022 capital investment plan for distribution has increased by about $240 million. This investment is focused on resiliency, targeted asset replacements, and growth for new customer load. Moving on to slide 40. This shows you the sheer size of our distribution system. We have 40,000 miles of distribution line, tens of thousands of assets that are out in the field right now serving our customers. Much of it has been out there for decades. The chart on the right shows the major causes of outages. As you can see, 55% of our outages are caused by equipment and weather. Our investments are targeted at reducing these types of outages and restoring power quicker when outages do occur. On slide 41, we use a systematic approach to target our most critical assets. We're utilizing data analytics to drive risk-based investment decisions around our lateral and feeder improvements. We're actively inspecting our 800,000 wood poles and replacing as needed, not only for public safety, but to improve resiliency in severe weather events. We're proactively testing our underground lateral cables so that we can do replacements in a planned, cost-efficient manner before the customer experiences an outage. And lastly, we're actively focused on those assets that are causing multiple outages for our customers. Not only are multiple outages problematic, but our customers' expectations for reliable service continues to increase. On slide 42, as I previously said, we are increasing our future distribution investments. Those increased levels represent a 35% increase from 2020, and our investments in risk-based programs has increased 2 to 3 times. We are focused on making reliability-based investments in the distribution system. I'll finish up on slide 43. In addition to replacing existing assets like poles and wires, as I mentioned earlier, we're also focused on technology and automation on the distribution system. There's more focus on technology in the distribution space today than I've seen in my career. This technology will not only give us the better insight into how the distribution system is operating, but it will also help us reduce the number of customers that are impacted by an outage, reduce the outage time when outages do occur, and reduce fuel costs for customers as we can manage the voltage on the system to optimal levels. I'll now turn it over to Steve Vetch to take a deeper dive on the transmission investments.
Okay, can you all hear me okay? I'm Steve Vetch, as Bruce said. I'm the Senior Director of Large Construction here at Evergy and responsible for the transmission investments. I want to go through with you today 3 things. I want to talk about our 2022 capital investment plan and how that plan is different from the plan that precedes it. I want to talk about the investments we'll make with those dollars. And then most importantly, I want to discuss the benefits we'll bring to Kansas communities as a result of those investments. I'll begin transitioning from the 2021 plan to the 22 plan on the chart here in front of us. So as we begin our transition from the 21 plan to 22, year 21 is removed or rolls off and year 26 is added. The difference between those 2 years is $101 million. In the 4 static years of the plan, years 22 through 25, we increased our investments as a result of projects coming in and out of the plan. We talked about dynamics earlier. The dynamics of the plan have added $27 million. And the net change between the 2 plans is $128 million, with the most current plan being higher. And that is a result largely due to rising costs. I want to take your attention to the investment benefits section of this slide. We use some terminology in this slide, and before going forward, I just want to make sure we've got a shared understanding of what some of this language means and give you some concrete examples. So a radial feed, we have resilience by looping and radial facilities. A radial facility is simply a transmission facility that is served by a single source of energy. The city of Hillsborough for decades was a town or a city in our service territory that was served by a very long radial feed. And as a result of that long radial feed had suspect reliability, I would say. Here within the last few months, we have brought a second transmission line into that substation. And now that substation has 2 feeds. So it is now deemed to be looped. Looped is 2 or more feeds into a facility, and a radial feed is just 1. So intuitively, more sources of energy are more reliable and more resilient than just a single feed. Resiliency and reliability. These are other terms that I'll use a lot today in my remarks. And resiliency is simply just increasing the force of which our system can withstand before it would fail. It's about making our system more impenetrable to we think about weather mostly, but also animals, even people. And as we have a more resilient system, the system becomes more reliable. So I think about reliability being a function of resiliency or a product of it. I'll give you an example of that. So Summit to Union Ridge is a project that we're planning to execute here in the next several years. And today that line can withstand about a half an inch of ice. Any more than that, and that line likely begins to fail. When we rebuild that section of line in 2025, the new standard to which we build it to will be able to withstand about an inch and a half of ice. So more resilient in this example in respects to ice. And that resiliency provides reliability, which keeps the transmission system open for business more often. And as a result of that, the customers have a greater access to the lowest cost resources that are available to them on the grid. And although it isn't in the investment benefits section of the slide here, I want to talk about capacity just a little bit. Capacity is simply for us increasing the throughput of our transmission system. And although a lot of the projects that we execute, capacity is not the driver of the project, it is a benefit that is received as a result of doing the projects. So when we increase the throughput of the system, again, we're increasing the access to the lowest cost resources for our customers, and that is a direct line to fuel savings. So I'm gonna move on one slide there, Cody. Okay, I want to take your attention on this slide to the bar on the far right. And what this bar is indicating is that 45% of our transmission system is more than 50 years old. I'm going to move one bar to the left. 19% of our transmission system is between 40 and 49 years old. So collectively, those two charts or those two bars are indicating that nearly 65% of our transmission system is more than 40 years old. So a substantial portion of our system, nearly 2/3. And at the rate that we've been investing in the system, those two bars continue to grow, although slightly. Cody, I'm gonna move one ahead. On slide 46, this is a more detailed look at the types of critical transmission assets that are aging at a rate quicker than we're replacing them. The two that I want to focus on the most are substation transformers and wood poles. Substation transformers could arguably be said that they're the most critical part of our transmission system. And at the rate that we have been and plan to replace our substation transformers, the percentage of the transformers that ages beyond their useful life grows slightly. Wood poles, I think that is somewhat more common or more intuitive. I think folks generally know what we're talking about there. At the rate we plan to replace those, they'll have a 2% growth in poles on our system that are beyond their useful life. Oil breakers, I don't want to discount oil breakers, but I will say we don't add oil breakers to the system. So as we replace oil breakers, the lot of them just get smaller. I would anticipate by the time we've retired the last oil breaker on our system that 100% of our oil breakers will be beyond their useful life. So it's a little bit misleading based on the percentages here, and just want to add that clarity. Go ahead. 80% of our projected transmission investment is dedicated to projects that improve the system resiliency. And we just talked about how that relates to reliability. So as we're going through our transmission projects, they fall into two camps. They are either mandated by an outside entity, normally the government, or they are performance projects. And performance projects are projects that are deemed by their design to increase the resiliency, the reliability, and sometimes even the capacity of the system. I'll give you a few examples on mandated projects too. The NESC, this is really a NERC requirement to make sure that our transmission system is meeting the standard of today, that our clearances are such that our system isn't in jeopardy of coming into contact with itself or anything that might be around it. We get notices to construct from our reliability coordinator of the Southwest Power Pool. And then we also have projects that are executed to serve growing load. We have a transformer addition in Johnson County within the next 2 years. And then new revenue and new customers are, certainly work that we do that is not optional. Panasonic is probably the most glaring example of projects that we'll execute as a result of serving new customers. Road projects, and I don't know if this is something folks think about much at all when they're talking about our transmission system, but we can incur expenses or investments as a result of the state wanting to or needing to widen a roadway. In Kansas 400 highway between Wichita and Benton, we have our facilities next to the highway, and the highway is planning to do a widening of the highway there. We don't have an easement for our facilities. They're in the road right of way. So as a result of that road project, we'll be asked to move our facilities to somewhere that's not in the road right of way and not where the road's going to be. And that is an investment that we would make that generally isn't providing a tremendous amount of reliability to the system, but something that we'd be required to do nonetheless. So yeah, the general takeaway from this slide is that 80% of the work that we're doing out there is dedicated to the parts of our system that we will be providing greater resiliency and greater reliability. And I'm going to take a drink here of my water just for a second, let this slide hang out here just for a second. I really like this slide, and I don't want to mess it up by talking too much here. But what this is telling us is that 98% of our performance projects are investments that we are making on the infrastructure that is more than 40 years old. So we are focusing on the parts of our system that give our customers the best bang for our investment dollars. All right, so this graph is a graphical indication of kind of all of our projects that we plan to execute in the next 5 years. 18 of these projects account for half of our spend. We'll talk about the top 5 largest investments on the next slide. But what I really want to focus on here is this long tail going over to the right. So this is 350 additional projects that make up the other half of our 5-year CapEx. And these are certainly smaller projects. We're doing breaker replacements in, say, Cherryvale. We're doing pole replacements. We're doing cross arm replacements. We're doing insulator replacements, relay panel replacements. It's certainly a tremendous amount of work that is stretching across our entire footprint. And in these additional 350 projects, I believe we are touching every single customer that we serve in a way that is improving resiliency and reliability. Okay, of the 18 projects that we were talking about on the slide that preceded this one, the 5 largest account for nearly 25% of our investment. I want to focus on just a couple here. One is Altoona to Butler, and the other one is County Line to Arnold. So Altoona to Butler is a transmission line on our system that's quite popular. It's known for its advanced age, and it was also identified by NERC as having one of the highest outage rates for its voltage class in the entire Eastern Interconnect. And if you're in the transmission business like I am, this is not something that you want to be known for. This line is also in a portion of our service territory that is congested. So we'll rebuild this line. We've already begun. And as a result of rebuilding this line, we are adding a substation south of Eureka, about 10 miles. Due to that substation addition, we're going to be able to add a second feed into the city of Eureka, which has been fed by a radial, as we talked about earlier, for as long as we've been serving them. So increasing their resiliency and their reliability and making a more secure energy source for the town and Greenwood County. And then as we continue on all the way to Altoona, by the time we're done rebuilding the line, adding the 2 substation, we'll increase the capacity of this line by nearly 4 times. So that is an absolute benefit, that rebuilding a line that's nearly 100 years old, although not the driver of the project, is certainly an ancillary benefit that our customers will see on their fuel bills. County Line to Arnold, it says 69 kV line. So this is a line, again, that was originally constructed in the mid-1920s. It was, in its earliest conception of it, was a direct line between Topeka and Atchison. In the late 60s and around 1970, a second circuit was added to these structures, and the company put substations in the towns of Meriden, Valley Falls, Winchester, Nortonville, and then on to Atchison. So we're rebuilding this line. It's in construction right now. It's proximate to Topeka, so what I would offer to any of the participants on the call today, if you want to take a field trip out to see what this stuff looks like in person, we would love to have you. But we're rebuilding this line. We started last year in Atchison, and we got about a quarter of it done. We're doing about a quarter this year, starting at Topeka and working up through Meriden. But when we are through here, this is a absolute for sure increase in reliability for our customers. And as a result of this line, the throughput or the capacity changes in this line will be about 5-fold. So a really good project from getting something that off the system that performs poorly and serves a lot of our communities. Okay, so this picture is a substation that we are rebuilding as a result of the Topeka to Atchison project, or County Line Substation to Arnold Substation, as we would refer to it. On the left is the old substation, on the new, the right. So when I look at this picture, the thing that really jumps out to me is just the sheer size of the new substation relative to the old substation. So the red rectangle on the right is the footprint of the existing sub. So about not quite 10 times the size. When we increase spacing in our substations, or any of our facilities for that matter, with the added size and the added space comes more distance between both the phases and each other, and the phases and the ground. And that space certainly adds resiliency, but the space is insulation. The more distance, the more insulation between the energized parts of the substation. Things that may not be obvious, but I'll point them out nonetheless. So on the left is what we would call open air breakers. So we have breakers that have been in the substation since about 1970. They are subject to wildlife. They are subject to all the weather. And generally, we experience outages as a result of these breakers being open to the air. In the new substation, right below the red rectangle looks like a Connex box. This is a switchgear building. So we would move these open air, or will move these open air breakers from an outside environment to an inside environment, and make the breakers what I would call completely impenetrable to both wildlife and the weather. So a significant improvement in resiliency and reliability. Other parts of this substation that might not be apparent. The old substation, the bus bar, if you will, is simply just conductor. And the new substation, the bus bar will be that. It'll be a 2.5-inch aluminum piping, which is much more secure, much more resilient, and much more reliable than what we've got there today. Another product of the new substation is, and it's obviously in construction on the slide here, not complete, but when this substation is complete, it will have a secondary bay for a transmission transformer. So if something were to occur to the transformer that's serving the load, we would be able to bring in very quickly a second transformer and restore service to this substation within most likely 24 hours. So a substantial increase in what I would call flexibility to operating the system that doesn't exist with the older style substation. I think that's all I got. Okay, so this triangular device in this picture is called a yoke plate. This one happens to be on our Wolf Creek to Wichita 345 line. This is one of the most critical transmission lines on our entire transmission system, and a line that we cannot take out of service to do work on. I want to do my best here to explain what this what it looked like when it was new nearly 40 years ago. And I'm going to take your attention to the picture on the right. So when this was originally installed, the pin that is depicted in red would have went through the hole depicted in yellow. So it would have been up, I say about 1/4 inch, and that's where it belongs. Over the course of being exposed to the elements and vibration and the wind, the pin has wore over time nearly all the way through the yoke plate. And you can make an educated guess, if you will, on when exactly this may fail. But I would tell you, this is not a piece of equipment that we would allow to run to failure. The consequences of doing so are certainly an outage at Wolf Creek, the potential for a grass fire, and a plethora of other consequences we'd rather avoid. So as a result of knowing what these yoke plates look like, we have done a full stock inventory on this transmission line. We are having a systematic replacement of the yoke plates, potentially the cross arms, and depending on the health of the entire structure, potentially the entire structure. So in the part that I want to point out probably more than anything else on this is not something that you would see if you were driving by this structure, if it was by the road, the things where they may be, aged or rotten. That is not what this structure would look like. But this degradation of this yoke plate over time is a serious and significant flaw in this yoke plate, and something that we are required and do invest in to mitigate the potential risks. Okay, this slide is shows a correlation between congestion costs and fuel prices. So as fuel prices are increasing, congestion costs do as well. They're a function of each other. As we're investing in our transmission system, as we talked about before, increasing the capacity of that system. And as a result of that increased capacity, we're able to mitigate to some respects the impacts of congestion costs for our customers. Okay, there's quite a bit to unpack on this slide, and I'll do my very best to explain all of what's going on here. So this is a configuration of our transmission system near Parsons, Kansas, and specifically around the Great Plains Industrial Park. And what I really want to point out here is the 3 feeds or the 3 substations that are inside the green boxes with the dashed lines. So these are radial substations. We had talked about those previously and how they're not nearly as reliable or resilient as substations that are looped. This part of our system is also between 60 and 90 years old. So it's something that, absent the radial substations, was already and does have our attention. Another unique part about this, and it being near the Industrial Plains Park, is that this is a portion of our service territory where economic development is trying to land. We are in conversations with potential industrial and commercial accounts who would like to locate their businesses here. But as a result of A, the configuration of our transmission system, and B, the shape of it, they're very clear that our system is not a system that would meet their needs. So I'm going to move one more slide here, Cody. So on the next slide is our plan to rebuild this portion of our transmission system. And as you can see with the dashed blue line there, light blue line, the 69 kV loop that exists there today with the multiple radial feeds would be removed, and a new 138 kV system with radial transmission substations would replace it. So this is a configuration of our transmission system that improves both the resiliency and reliability and the capacity for our existing customers, but also builds our transmission system to an expectation that would allow future development in this area and meets the expectations of those future customers. And I would just add here, I think on the end, is economic development is important in every community, but if you have less of it, it's even more important. So these communities in Southeast Kansas need a system by us that would allow for them to attract additional customers. And with that, I'm all through here.
Well, Steve, thank you very much. This is Dwight Keene. If we can go back to full screen again, please. All right. I think the next thing we need to do is take a break. We've been going for about 1 hour and 45 minutes. And so why don't we take a break? Let's take about a 15-minute break. We'll come back and resume at 2 o'clock. We're in recess until 2. Thank you. Commissioner Duffy and French, are you back?
I am back. I did not leave the territory.
Commissioner French, are you back? All right. It's 2 o'clock. We'll go back on the record. Chuck, I'm going to hold off on you for just a moment here. It strikes me, I think, that we have several quite distinct segments within the presentation today. Transmission and distribution is one of the important segments. So, Steve, if you're still with us, and Bruce, are you still with us? Yes. I am. We're going to double back and have a round of questions for you if you're up for it. We'll probably do it if you're not up for it. You just leave.
We're good.
I shouldn't have asked that question, let alone rhetorically. Okay, let's begin with the staff. Let's see if the staff has any questions regarding transmission or distribution. I'll begin once again with Jeff McClanahan.
Chair Keen. It was noted in the presentation, I think it's been noted a couple of times that Evergy didn't put a lot of capital investment into transmission distribution during the 70s, 80s, et cetera. That's not unique though to Evergy, is it's my understanding. That's pretty well across the board, right, of most utilities.
Yeah, I think that's right. And that's why you're seeing investment in the same assets classes that we are by our neighboring utilities.
Okay, thank you for clarifying that. And then I'll try to make sense of this next question, but as a regulator and other stakeholders, as we view not just Evergy's, but other jurisdictional utilities, capital investments, the question always becomes what's necessary for reliability due to aging, or what's mandatory versus what might be discretionary. Discretionary is probably hard to define, and you could look at it in like the new technology would say, but of grid automation. But even that, it could be cheaper to go ahead and put that grid automation on while you're doing your reliability work as well. So I know affordability is one benchmark that you look at as you're setting your budgets, but what are some of the other factors? How do you determine just how far you go with your annual capital budgets, if that makes sense?
Yeah, I guess I would start with, looking at it from an affordability standpoint. I mean, we have a list of projects, both T and D, that as far exceeds what's in our capital plan. And that list of projects is based on reliability of the system, the age of the system, condition, not just age, but based on condition, but age is a leading indicator. But all of those factors go into our project list, if you will. And then just through the budgeting process, through this process, we determine amongst a number of factors what we can do in a particular year or over a 5-year period. And that's what, and then we prioritize within those buckets of money how much we can invest in the highest priority items.
Thank you. I think that answers my question. Leo, you have questions?
First of all, I want to thank Chair Keen for giving me 15 minutes to write all these down for you. Good afternoon, Bruce and Steve.
Hi, Leo.
Steve, you mentioned that resiliency was the increasing the ability to withstand a higher force. Could it also be said that it just lowers the probability of failure? Is that another way to look at it? What's a really good definition of resiliency? It seems like it's all over the page.
Yeah, I think both of those definitions kind of fit the bill from a resiliency standpoint, Leo. In terms of being all over the page, I think anything that we're doing that makes the system less likely to be unavailable is building resiliency or reliability into the system from a transmission standpoint definition.
then looking at back on slide 38, which was the pictures, kind of a plot from UMS. I think Bruce had this up there for Sadie and Safety, or Sadie for both Metro and Kansas Central. It shows the first 3 years as being relatively a flat line. Is that just the reference point you guys were using for like 2021 and 22 as being the point you're measuring from, or UMS was projecting from?
Yeah, generally when they
I can't hear you, Bruce.
there we go.
There you go.
All right, sorry about that. Generally, when they look at grid modernization plans, as companies undertake those, there is a lag from when you start those investment programs before you start seeing real benefits. I'm trying to get back to that slide here. And so that they started looking at it from our investment from 2020, and so they, in their analysis, they built in I think 2 to 3 year lag before you start seeing any material benefits. But even with that flat line, to the extent that if we hadn't made these investments, the line would have went up. And so there is a benefit. So you need to look at the gap between the green line and the dotted line to show the real benefit.
That projection, how are they reaching that projection? Just based on the age of equipment or your failure rate that you've had historically?
Yeah, they looked at, I can't speak to specific details of how they did it, but they had a detailed model that took our data and rolled in based on performance, age, to the extent we had condition-based data, and incorporated that all into their model to make those projections.
Also, Steve, you had mentioned the Hillsborough project as being a classic resiliency project, and I agree. It definitely lowered the probability of failure for the city of Hillsborough. But as I recall, Hillsborough didn't really have a lot of failures before this. It was an old system, but there weren't a lot of failures in the last 5 or 6 years, if I remember right from our previous STP discussions.
Yeah.
So how did you pick that one versus the other ones, right?
Yeah, so a good question, and I can't speak to what Hillsborough's reliability metrics looked like prior to us choosing this project and not some other project, Leo. It precedes me a bit. The reality of it is that it's in the beauty's in the eye of the beholder, right? So how many is too many? So if you're a resident of Hillsborough and you have an outage or you have a couple outages, that may seem like a tremendous amount of outages, but if you don't live in Hillsborough, maybe it seems like it's not as great of an issue. I think what we had heard from the city is that we were not meeting the expectations of their reliability desires, right? And after looking at our system, what was feeding them and how it was behaving, that is when we arrived at the project that we executed here just earlier this year. So I don't think it's, one thing or one point that we're saying, okay, this thing happened, so we're going to do that. I think it's taken a lot of information and a lot of context, looking at what what is being served too, kind of goes into the equation, and collectively stacking that up with all the other things that we may invest in ranking them from a risk profile and coming to a solution. And sometimes it may be imperfect, but generally I think we do a really good job of managing our projects and mitigating the risk that is out there on the grid.
You mentioned also on one of the slides right around there that you had I think 80% of your projects are performance projects. And then there's 87% of the whole plant that is more than 40 years old. So age becomes almost like you have to do a subset of that, I would assume, to figure out how to prioritize those. Do you have I think you do, I don't remember what they were, various, like an algorithm that tells you how you prioritize these projects for transmission or for distribution?
Yeah, so I think that's the model that Bruce was talking about that UMS used, right? So they take our system information and they enter this into the model, and it makes a projection as we go forward with certain levels of investment, what we can expect to see from how our system will behave standpoint. And if we are reducing or not investing in our system, we can expect to see, these types of outages going forward. I don't know if that answers your entire question.
Yeah, I was thinking,
Leo, yeah, what I would add to that, we do have an internal analytic system that factors in age, condition, and so forth, number of different factors, reliability, to help us prioritize those projects. So that it's called Asset Lens. So we utilize that to help us prioritize our projects. And I guess I would go back to your previous question on Hillsborough or any project. If we wait till we have, especially on a transmission project, so many outages, and then start the planning and process then and get it in construction, the horse will be far out of the barn before we can get the door shut. So, once you start having those precursors, then you take a look at the system and the condition of the system, and that the things that go into, all right, we need to get this line rebuilt because it is in bad shape and we've been biding time, if you will.
that's a fair point. That's a good point. On your slide 50, you showed several projects. I think it was Steve's part of the presentation where you were, it's El Dorado to Altoona to Butler, rather, Mormonton and Neosho, and so on.
Yeah.
Were any of those projects subject to an NTC or considered for an NTC?
I don't believe so, Leo.
Okay. Then I have one last question. This goes back actually when I was reviewing slides from during lunch. So slide 15, where you're talking about, I think it was Mr. Campbell was talking about OSHA recordables or days away from work. And those slides you're showing where you're seeing this decrease in reportables, is that just Evergy employees, or does it count for all your contractors that are also working on your plant?
Yeah, that slide represented our employees. But I would say we work very closely with our contractors and hold them accountable. I mean, if they can't work safely, they can't work on our property. I don't know their number right off the top of my head, but we have definitely not seen a degradation in our contractor safety performance. And if they have, they don't work for us anymore.
Okay. Thank you, Chair King. That's all the questions I have.
All right, thank you. Justin.
Yeah, hi. Good afternoon, everybody. Just one question for me. Am I able to share my screen? Looks like I am. So instead of asking for permission, I'm just going to ask for forgiveness, I guess. So one of the things I was doing, preparing for this workshop is going back and looking at the last workshop and at the last presentation that you guys provided pertaining to distribution and transmission. And I'm trying to understand, I mean, there's obviously something going on here in terms of either definitional, where assets fall within categories, or, I don't know if there's just been that much progress made, but I'm going to just flip back and forth between these. This is your slide 46, where we're talking about substation transformers. And, the message here is, even at this level of investment, we're not necessarily making a lot of ground, right? Not gaining a lot of ground. And so for substation transformers and wood poles, these numbers struck me as a lot lower than where we were projected to go for substation transformers and wood poles for even after the full 4 years of the STP. And so, this is something that sort of just caught me recently. So I don't mean to catch anybody off guard, but if you guys could provide us, some sort of a rundown of what could have happened between the two views, between this view and your current presentation, that would be really helpful for me.
Yeah, we can certainly do that, Justin. just some things that it possibly could be. This is a look at Evergy Kansas Central only versus the other one was included Kansas Metro. And it could be that just given the supply chain constraints that it's changed the mix a little bit. I know, for instance, transformers are harder to get, and maybe it's moved some of those out in the window a little bit, but we can certainly scrub the data and do the comparisons for you.
That's all I have.
Yeah, I suspect you're right, Justin. We'll need to look at the definition on the transformer side because this is a lower percentage. So what Bruce cited might go the other direction in terms of supply chain. I think the poles is likely due to the mix of adding in Kansas Metro, but we'll check and see if there was a definitional issue on the substation piece. So thanks for calling that out.
Thank you. That's all I have, Cherokee. Thank you.
Okay, very good. Curb questions? Any questions, Mr. Astram?
Yes, sure, Keen. Thank you. Thank you for your presentation on the transmission and distribution. Obviously, reliability and efficient service is important to Curb and its constituents because that's why they have electricity service. So Jeff McClanahan asked an interesting question about kind of the trend for utilities in the 70s and through the 90s to kind of take a hands-off approach on investing a bunch into transmission and distribution updates. And so could you give us a little more context about why that is exactly? And was there any sort of change in the early 2000s through now that kind of shifted that focus, at least from Evergy's perspective?
I'll comment broadly, and then maybe I'll defer to Bruce for our system because I can speak to having worked at several other utilities. It is a nationwide pattern. I'm really glad that that Jeff McClanahan mentioned that because it was a general pattern. It's frankly true for a lot of the infrastructure in the United States. If you think about bridges and roads and pipelines, a lot of that was built in the 50s and 60s, and investment went in other directions. In our industry, what happened in particular is there's a real focus on generation. And that took a lot of money. And in many cases, many utilities built nuclear plants. All of those nuclear plants, except some of the very early ones, went way over budget to a degree that it actually threatened, in many cases, the whole construct for the utility. So they pared back wherever they could, and with relatively newer T&D systems, there was a lot of focus on the generation side. There was a wave of gas build-out that also happened. There was a wave of coal that happened in the 70s and 80s. So there's in particular focus on the generation side that took a lot of the limelight at that time. I think the transition in many ways started happening in the 2010s. And as Bruce mentioned, you really see it across the whole US industry. It's part of why there's been such a shortage of line workers and a real premium for that group of employees, because it's been an investment level that's been taking place across the sector. But the main drain that caused it was a focus on generation in particular, and a lot of the knock-on effects of the nuclear build-out in the U.S., which was, for those of us who were either in it or at the tail end of it, it really skewed the whole approach for many utilities because of the sheer scale of cost overruns that happened in the nuclear side. And Bruce, maybe you want to comment if there's anything else you want to add.
Yeah, in the 70s and 80s, for example, think about it. There were not 100-year-old transmission lines. They were only 60 or 70 years old at most at that point in time. So it didn't necessarily make sense to reinvest because the system was younger. You think about it, the build out of and electrifying the country when that happened, and that age of the system. And it's just, as we moved on, we've got as much good out of the system as we can. And it's at that point in time now where we got to start rebuilding, because there is tens of thousands of assets out there and we can't do it overnight. And so focusing on those most critical things that are putting reliability at risk and start working through this is where we're at today. And would I've liked to started 10 years ago? Absolutely, on the distribution system, but we are where we are, and trying to manage our customer expectations for reliability have continued to increase too. That's another a key factor.
Thank you for that. And no, I certainly get that last point about, as we're approaching 90, 100-year-old lines. And I don't know how to put this softly, but 60-year-old lines, as far as transmission and distribution equipment goes, still seems very old. just as far as that number goes. So thank you for that context there. And so kind of comparing and contrasting with David Campbell's presentation earlier about customer satisfaction. And I didn't ask this too much about then, but as far as that metric goes, is that in regards to like reliability and quality of service as well? And then when you compare it to the SAIDI impacts that are projected here on slide 38, it seems like there's a pretty rapid drop off if you maintain pre-2020 investment levels versus going with the 2024 capital plan. So what exactly can you help reconcile like those, I guess the benefits for customers between those two slides? So I guess my phrase another way is what exactly is happening now in the last couple of years, like 3-4 years, that's the impetus for this vast increase in transmission and distribution investments, notwithstanding age of the equipment getting to a certain point? Is there some sort of like increase in like reliability problems currently happening, or?
Well, I think as David mentioned earlier, a lot of utilities, including us, were investing in generation assets for a significant period of time and trying to manage the impacts on customers. We couldn't do both, so I think a lot of utilities put off the investment in transmission and distribution because it's much different than if you have a power plant that you lose. That's a big asset providing service. And you look at a transmission distribution system, particularly, has a much smaller impact when it fails. But that's part of what we've been looking at, is that bow wave is growing. And that's why if we don't get started now, we're never going to be able to keep up. And we're going to see a significant degradation in reliability if we don't start now. As far as the customer satisfaction score, I'll defer to Chuck Casely to answer. There's multiple things that go into that, not just reliability.
So the specific slide that you're referencing is JD Power and Associates overall customer satisfaction. And as part of that index, it's actually a composite of different factors, but power quality and reliability is one of them, and is weighted slightly more than 20% in how they come up with those numbers. And so it's definitely factored into that. In addition to that, I would tell you one of the things that Bruce has said, but driving this home, I think is really important. And that is customer tolerance for outages now is so much smaller than it was 20, 30, 40 years ago. If you think about it, just within the last 10 years, almost everything you do in your life and almost everything a business does is automated. It requires electricity. It is sensitive because they're computer equipment and other technological things. And so when the power went out before, for a home in the 80s, you had to worry about your refrigerator, and that was about it, right? Because everything else wasn't critical. Now, whether kids can remote in to school, whether you can run your computer, which runs a significant part of your house. A lot of gas ranges, for example, if you don't have electricity, you can't even start those because they require electricity to run the stove. So, and then as we get into electric vehicles and things like that, that's only going to increase. So as reliability increases its importance, that's where we kind of have an intersection with this need to replace this aging infrastructure.
Thanks for that. Yeah, I appreciate that, everyone. That's a good point. I guess kind of a follow-up on that, just from a timing perspective here, we're looking at a plan based on 2020. That was also the start of the COVID-19 pandemic. And so did the kind of shift that Evergy experienced as far as like load profiles and for example, customers working from home versus more centralized office buildings, did that have any impact on decisions to increase investment in reliability and distribution type projects?
I don't know that it materially changed that, but it definitely raised the reliability concern more, because as you have people working from home, they lose power, then they can't do their job. So I think that is one of the drivers for customers' pressure for higher reliability in their electric service.
Thank you for that. In regards to some of these projects, you mentioned the percentage. Let me pull up the slide real quick on my end. let's see here. It was on slide 47, talking about the ratio of mandated projects versus performance projects. And just to kind of clarify that, when you talk about these mandated projects, these are ones from like FERC or SPP that you're required to do as part of the larger regional transmission planning. Is that right?
That's correct.
Okay. And then so the vast majority of it is kind of Evergy's discretion in regards to like the local system. Is that how that's framed?
Yeah, I mean, I think you could frame it up like that, Joseph. The slide is indicating that 20% of our projects are mandated to us by some entity that's not us. The other 80% of the projects that we're executing in our 5-year plan are projects that we've deemed to be the highest valued projects that we can invest our dollars in.
Okay, that makes sense. And I guess kind of pulling it all to a point. You mentioned that the focus on generation and decades ago and it kind of even up till recently was more geared towards investing in generation, and that transmission kind of took a back seat to that, but now you kind of switch gears. But just looking by the general increases year over year from the capital investment plans and even from the STP, it seems like Evergy's trying to drive up on both lanes, both in generation and transmission and distribution. So is there an explanation for that at all, or is the timing just a coincidence, or is there going to be some sort of overlap and improvements between investments here with generation and renewables, for example, and also these discretionary or prioritized performance projects? Is there any sort of connection between that kind of these increases in both sides of the investments?
In general, I'd say no, with one exception that I'll note. So I think Bruce described it well in really noting that when you had a young system, it enabled and allowed you to focus on generation, and we're just not in that position now. And I really like Bruce describing it as sort of bow wave, and we didn't start 10 years ago. We are where we are, and we really need to make these investments to stay ahead of the reliability challenges and ensure our system's resilient, meet expectations. The generation side is a little different. I think the opportunities that we evaluate are really looking at our integrated resource plan. As Kayla described, what's the best net present value from a overall cost to customers to have the capacity and energy that we need. Now, the generation system is also aging. If there are big lumpy investments we need to make in 50-year-old coal plants, those will be some decisions we look at hard relative to putting in a new, a combination, for example, of renewables, potentially a peaker. So the generation is really evaluating what's the best cost generation fleet and mix of resources to have over the next 20, 30 years. And with the cost of renewables, both from an energy perspective relative to for the standalone, but also relative to what we have in place today, that's what's really driving what we see as an opportunity to save money in the savings that Kayla identified. There is an intersection on the transmission side, ultimately between the generation fleet that's in place across SPP and transmission needs. That's not the driver of our capital plan here now. I think you may see that in the back half of the decade, in the 2030s, as our generation fleet broadly across the SPP region transforms, you may see more transmission that's built out directly related to making sure we can have the generation fleet serving load. But that's not the driver of our plan here. So I'd view them as slightly different, with a different lens as to what the rationale is and the benefits that we're seeing that each are driving. We see the benefits of both sets of investments, but there are different lens and set of analyses that informs them, if that makes sense.
That does. Thank you so much. I'm going to try to shift gears and put on my engineer hat just slightly. So a lot of these transmission and distribution improvements that Evergy is making, are they taking into consideration kind of the advent of like privatized solar, like people putting rooftop solar and having more distributed energy generation and this two-way exchange of energy between the utility and private houses and businesses? Is that being factored into these projects as well, or is it something separate?
I would say generally separate, although, as we rebuild the line, we're rebuilding it with generally more capacity, knowing that the customer load has increased, particularly since when the line may have been built 40 and 50 years ago. We are investing in technology on the grid. It's still obviously in the early stages, but that's the direction we're going to bring that all together and trying to nail down the timing and where that rooftop solar and all those things are going to happen on our grid is still a bit of a challenge. Kayla, if you've got anything you want to add.
Yeah, I can just add one thing. 1 second. Turn my camera back on. Maybe. Nope, maybe not. Okay, so I'll just add one more thing. Oh, there we go. I think there was one slide that had the automated devices on it. So this is not a transmission specific question or answer. But on the distribution side, a lot of what we're doing is installing more sensors. Eventually, we're going to work to install a voltage management software with volt bar optimization, which, as Bruce mentioned, does have the potential to manage fuel costs, and it can create savings for customers, but it also gives us visibility and control to voltage on the system, which is very important as you're trying to manage bidirectional flows. That's one of the main things, is just how do we get better data on those bidirectional flows so that we can know where they are, keep the system safe for our employees who are working on it, for customers, as there are faults that might take. Then we have a generator that's pushing back on a line that's just gone out of service. So those are all the things we're going to look at. There's some more detailed things like system protection is impacted by bidirectional flows. So some of what we do on relay replacements can help to prepare the system for that, but that's a more targeted benefit. The data and the control is what's more important in preparing for that.
Okay, great. Thank you for that. I appreciate it. Again, not a big engineer hat, so I just wanted to ask and see where that was going, since it was a topic not too long ago. In regards to resiliency, how much of these performance projects are related to any sort of lessons learned for weatherization, like from Winter Storm Uri, in response to that? How much of that's being dedicated to that issue and trying to harden the system against those kind of interruptions?
What I would say from the transmission system, we have a standard to which we build the system out to today, right? We talked a little bit about how that standard is more resilient and robust than the standard that precedes it. I think I used an example of ice loading on our current existing line that we're rebuilding, and then what it would look like thereafter. Winter Storm Uri was, as a result to the kind of the substation, the transmission system, more of our issues were inside the substations. So we are taking a deeper dive in terms of our breakers, the types of breakers that we would use, our maintenance cycles of the breakers, and ensuring that if we had a like event in the future, that we would see a significant decline in the number of breakers that operated poorly during Uri.
Gotcha. Thank you for that clarification. I appreciate that. And then just generally speaking, for some of your larger projects or projects in general, both transmission and distribution, does Evergy perform any kind of cost benefit study regarding these types of projects and its consideration for prioritizing which projects to perform at this time or push down the road?
Yeah, I mean, I think I mentioned earlier, we have an internal model that prioritizes our reliability projects. I think if look at my colleagues here, a component of that is a cost benefit analysis. So it incorporates a assumed cost of an outage, if you will. That's a bit of a difficult number to identify, but that goes into our calculations. So for example, a circuit that's got a hospital on it, the cost of that outage is much different than a pure residential circuit. And so those types of things are what is incorporated into that allocation model or prioritization model.
So a cost benefit analysis is more part of this larger modeling software that you use versus like an independent study of those things?
Correct.
Okay. I think that's all the questions I have for now on this. Thank you so much, everyone.
See if we have any commissioner questions. I'll begin with Commissioner Duffy.
Thank you, Chair Keen. First of all, a real shout out to your employees who, during a storm or after a storm's passed through and the conditions are still miserable, they're out there in their trucks on the line performing the work that needs to be done. It's always interesting to look at the ticker tape and see, hey, everybody's been connected except for 11. And you wonder, where are those 11? And they're just as important as the maybe 70 that you connected with one repair. So I know that work is important. I do, Steve or Bruce, want to understand in terms of the replacement. So you're going into an aging system. Has anything changed in terms of the poles, the wires? Is it still your grandpa's wooden pole in the ground? And you've talked about, in some instances, you're increasing the capability of what that strand can hold. How often, what's the percentage where you're actually increasing the voltage? And do you have to have additional right-of-way for some of those changes? If you could respond between the two of you.
Yeah, I'll start and then turn it over to Steve to cover. But thank you for your comments on our line folks for the work they do. They appreciate that, and I appreciate that you recognize that. So generally, and I'll talk kind of combined transmission and distribution. So as we're replacing our assets for distribution pole, for example, we're increasing a much heavier class, a much bigger, larger round pole that is stronger. The cross arms, instead of wood, they're fiberglass, different configurations that can withstand the weather impacts that we've seen, and much of that also applies to the transmission system. I'll let Steve address how that impacts, especially when you change voltage classes.
Yeah, so I'll tackle this a little bit from the transmission avenue. So one of the things that we do in building resilience is look at what's harming the system. And I'll give you an example on the projects that we're executing as a result of these yoke plates that are wearing through and pose a significant risk to us. A lot of these poles are through the Flint Hills, and this is a part of our service territory where we have seasonal burning. As a result of that burning, despite our best efforts, we have structures that are burned up each spring. So if we're going through those portions of our service territory, we'll replace those wooden H-frames with steel H-frames. So it's not the same as what was there before. And the steel is what we call wood pole equivalent. So they're manufactured in Salina, and something that I think we have a little bit of a competitive advantage, if you will, on, just because of the proximity to the manufacturer. But that's an example, Commissioner Duffy, of something that is different than we would have done it even likely 10 years ago or even 5 years ago, just learning our lessons from the past. The conductor is certainly larger than the conductor that precedes it. And that is building to a larger, more robust standard. So with that comes additional capacity, and we talked about the benefits that brings to our customers. But it also makes the conductor stronger, right? So it has generally more strands of steel through the middle of it than what has preceded it. And that adds to, as we talked about earlier, the resiliency of the line, and then of course, the reliability of it.
Does any of your work necessitate going back out to right-of-way and taking of expanding your right-of-way in those lines?
Yeah, so it does on occasion, right? So our goal, my goal as being the leader of the transmission construction, is if we don't need additional easement, that we don't acquire additional easement. If we've got 100-foot corridor, our ask of our engineers is that they design a line that stays within the confines of that corridor. And if they, for some reason, feel like it needs to be increased by 25 feet, that we'll have a discussion about why that is, what it would take to stay inside of our current corridor, and just have an open conversation and not have these, always and never processes in our transmission construction operation. We want to talk about each project, the specifics of each project, and then make decisions on the merits of those projects, rather than just saying we're going to always do this and we're never going to do that. So that's how we're approaching it.
Okay. Are the people who do the work with replacement, are most of them your employees, or are they contractors?
Yeah, so on the transmission system, all of the workers that work on the system, from boots on the ground, hoisting the poles in the air, putting them in the holes, those are all contractors. So in our large construction and transmission maintenance, arm of our company. We have 7 employees that oversee all of the transmission maintenance and all of the work that is done by all those contractors. In our large construction side of my responsibility, we have project management teams that are real estate folks, construction folks, engineering folks, accounting people, and whatever discipline that our project managers may need to successfully execute a project is what we add to the team. And those are all employees, but when the large construction group and the project management comes down to construction, we have certainly people that oversee that, but they don't do the actual construction.
Okay.
Yeah, so that is bid out.
Is that a change from past practice, even like 5-10 years ago?
No, we've never had internal construction crews on the transmission side. I was just going to make the distinction between that and distribution. We do have our internal linemen that work construction, but we also supplement it with a significant number of contractors. Our internal folks their first responsibility is to respond to if we have emergent events like an outage and so forth. And so they generally don't get on the larger distribution projects, but they do construction work as well.
Okay, so let me ask you, in terms of supplies, your ability to adequately receive from the supply chain, is that being compromised right now due to COVID and other things? And same with whether it's a contractor or your own staff, boots, are there actually people in those boots that you need on the ground?
Yeah, we right now we don't have any concerns about from a people standpoint of attracting folks and having enough contractors to do the work. We fluctuate that as the projects come and go. From a supply chain, from a material standpoint, particularly on the distribution side, distribution transformers has been a significant hurdle for us, and not just us, other utilities across the country for the last probably 2 years. The big constraint was the core steel in the transformers comes from China. And obviously COVID and the workforce issues impacted manufacturers as well. So that has been a big impact, and probably the biggest impact from a customer standpoint is subdivisions where developers are wanting to build out multiple lots. We just don't have the pad mount transformers to build out the whole lot. So we work with them and allocate them. Other assets, the lead times have extended out from a few months to several months, but particularly on the transformer, we're starting to see some improvement, and our largest manufacturer, a supplier of those, is expecting that within the next year we should get back to normal supplies on that.
Okay. All right, thank you. Finally, the recent vandalism activity in North Carolina, and I believe in the state of Washington. Is that going to change anything that you're proposing with your plan here to mitigate potential vandalism damage on your property?
Yeah, so I'll take that. I think I believe we're going to have to change something, Commissioner, but I just don't know exactly what it's going to be just yet. I think we're just so close to this event having happened. But I think as we look around the table, we understand that the way that we have approached potential vandalism or even sabotage on our system, thinking it's so unlikely, it's not something we would generally think about a lot, is changing or has changed. I think that's a continued dialogue that this group and the commission will continue to have over time, so we can, I think, collectively determine a path forward and what it would take to protect our assets from an attack such as the one that they had in North Carolina, and then I think what appears to be somewhat of a copycat in Washington.
I can remember clearly 15 years ago, Carl Holmes, Representative Holmes, talking extensively about his continued concern of vandalism out in the more rural areas, and however are we, and the vandalism was with a long gun and how you protect those assets. So the conversation continues, and yeah, I agree.
It'll be
It's a
tough.
shared conversation.
Yep. And we'll coordinate closely with the industry as well. As you can guess, this is an industry that's got a lot of attention nationally with our whole industry. So we'll work with them, but it is a challenge, as you know. It's a lot of distributed facilities, mostly with chain link fences. We're gradually getting better connectivity for cameras and others, but as you know, that camera's not going to stop a long gun. So the physical hardening, it's, across the US, across our system, we're talking thousands and thousands of structures. So we'll have a dialogue with the commission and learn along with the industry on what to do, but it's a tough one. I certainly hope the copycat dynamic mitigates, but we'll see.
Thank you. And thank you, all three of you. Thank you, Chair Keen.
Commissioner French.
Thanks, Bruce and Steve. A lot of great information. I don't think I actually have any questions for you, but I want to make a few comments just because it flies under the radar, but this is probably the most important of the sections from my perspective. I mean, it's no secret to my colleagues and maybe some at Evergy that I've shared a lot of concern about transmission spend recently, and not so much on the regional side. To me, that goes through a lot of scrutiny through the SPP stakeholder process, or it's a NERC requirement. And so, my concern is obviously not there. My concern is on sort of what a lot of what we talked about today, which is the local transmission spend. And it's not a reflection of you or your decision making. It's a reflection of, it's a structural issue. It's a process issue. It's a jurisdictional issue. We have what ends up being a pretty opaque planning process to a state regulator. These are projects that are, as you all discussed, they're self-directed. They're not usually the product of notice to construct from SPP. They're not ultimately subject to review by SPP for the most part. FERC, even though they set the rates, they do not review a lot of the projects for prudence. So it creates a lot of questions in a regulator's mind of, who is reviewing, what the pace is. If FERC is ultimately jurisdictional, but they're not telling us these are done at the right pace. Who's looking at, could a grid enhancing technology have forestalled investment, or could it have solved the issue where you've got a constraint maybe only once out of one time out of the year, and you could put on a few $100,000 of grid enhancing technology instead of rebuilding a $10 million line. A big thing for me is, are we looking creatively at bigger projects to displace a bunch of smaller projects and maybe not do the rebuilds? Are we building a bigger grid of the future rather than just rebuilding what we have? And to be fair, I think you've provided some information in your slides to show that you are considering some creative solutions. But that is why I've probably made some comments saying that I think there is a role for maybe an independent transmission monitor to help us with benchmarking, to help us understand where our dollars are going, how our utility is performing as they invest in local transmission. And I agree. It's hard to argue that there's a need when your assets reach this sort of age, but it is such a large amount of the dollars. This is where the dollars are. We're here to talk about the capital spending plan, and there's a lot of fun topics, but this is where the dollars are. And so it's obviously where a lot of my concern lies. And so I just want to make sure that we have open lines of communication. And I think something like today is really helpful. I would like to see some more reforms on the federal side that could maybe help us get more comfortable with what's going on. As I said, I think you all provided good information today. It does help me understand where your heads are, where your planning trajectory is. But, I don't have all the answers, but want to make sure I do express my concern, just because I don't want anybody to think that this issue is something we glossed over. It's serious. And that's all I've got as far as a comment. I realize it wasn't a question, but if you have any response you want to give, I certainly want to give the opportunity, but I wanted to make sure I didn't let the moment pass.
Yeah, no, I appreciate those comments, Commissioner Friends. You did remind me something that I'm sure you know is working with the SPP, but for all the other listeners. So looking at the notices to construction, and it's a fairly small bucket, but the key thing to think about there when the SPP is looking at the transmission system from a reliability standpoint, they're looking at it from a N-1 contingency. So if you lose this line, is there another line that can handle the load and has the capacity to handle that load? They are not looking at the condition of that line. And so it could be 100-year-old line, but in that model, it looks like it's a day old. And so that's a significant distinction between what the SPP is looking at versus what we're looking at to serve our customers. We're looking at it from a pure, is that wire going to stay in the air when we need it in the air? So I just want to make sure that everybody on the phone understands that distinction, because that's a pretty big misunderstanding by a lot of folks.
Yeah, that's an important point. I appreciate that. That's all I had. Thank you.
Thank you, Commissioner French. Well, thank you, Steve and Bruce, for all your input. I've got a couple of questions. I'm going to direct it to the two of you plus David, and you can pick and choose how you go about approaching it. I'm trying to kind of go back up to 30,000 feet here for the overview level in terms of transmission. I think that I quite agree with Commissioner French. He summarized that this is where the money is. This is where there's a lot of huge investment is in this part of your operations. What level of capital expenditure is attributable to transition for new renewables versus performance transmission projects?
I think we're going to get Kayla to hop in here and help us kind of sort through that, Commissioner Keen.
All right, which starts the waiting game for my camera, but can y'all hear me?
We can.
Okay, great. Yeah, so under the current processes with SPP in terms of cost allocation, the interconnection and network upgrades required to interconnect new renewables are direct assigned to the generation customer. So while we might have some projects in our plan that are associated with generation interconnects, we're reimbursed for those. So they get netted out in our capital dollars. So they're not actually driving the numbers that we're talking about, but there are some projects in our plan that are associated with generation interconnects.
Okay. If I go back to the, I think, Steve, I think was your favorite chart.
Okay.
Yeah, I think your favorite chart was
slide 48.
Yeah, 48.
Mm-hmm.
Where's the other 2%?
Yeah, and I looked at that, Commissioner, here a couple of weeks ago when I was going through this, and I can't tell you at the moment. I'll have to get that to you. It's definitely, here's what I can recall. There were multiple very small projects that made up this 2%. And they were a relocation of our own facilities around a substation was one of them. But I can definitely get you, I think, the 8 or 10 smaller projects that encompass that 2%. But I just can't remember what they all are at the moment. It's not one thing.
Okay, relatively smaller projects. So.
Yeah, absolutely.
Yeah, okay. My last question is this, and I'm probably directing this to both Kayla and to David, because I want to get your take on a concern that I have, and maybe you can allay the concern, perhaps. Maybe it's misdirected. I mean, I'm an all the above kind of guy. I believe in the commitments, and certainly the commitment that you've expressed toward having a balanced mix of portfolio fuels. I'm all in favor of the clean the newer the renewables and the transmission planning that's going to go with that to a point. I'm all in for trying to unlock the benefits that Kansas has with these tremendous resources, this wind resource that we have, provided that those receiving the benefits pay the full cost of those benefits. That's my concern. So I guess, first of all, I would ask you, do you agree with this proposition, or do you have concerns with it? Have I oversimplified it? Do you understand what I'm driving at here by way of allocation of costs to those receiving benefits?
So I'll lead off, Chair Keen. I think I'm tracking. I think that and I think there were 2 points embedded. With respect to the diverse fleet, and implicit in your question is the risk of moving too fast towards renewables and net zero. I confess that when I hear plans of an aspiration to get to net zero in the power sector by 2035 and require it across the US, that does make me nervous. That's 13 years away, and that would be very, very difficult to achieve. And we're going to need some technology breakthroughs to make it work by 2045, 2050. I'm enough of a believer in technology that we're far further along in terms of emissions-free resources now than I would have predicted 20 years ago. But I think by 2035 is too fast. I do think we're going to learn from some other parts of the country. I think California's kept on a lot more gas, and now the federal government is going to help fund the extension of their nuclear plant another 5 years to the tune of $1 billion. So we all, as federal taxpayers, will help them reverse their decision. We will see in some other jurisdictions that are trying to move faster the consequences of moving too fast. So I actually have some hope that part of what you're seeing in the Southwest Power Pool, for example, is they raise the reserve margin requirements, as they take a sharper look at renewable accreditation, and in effect, putting a higher value on capacity that will help to drive decisions that are prudent in terms of a diverse generation mix. And the main risk factor is federal policies that drive a pace of change that outpaces affordability and technology. But I'm confident that we'll ultimately be able to find a balance, and there'll be some regions that may get ahead of some of those mixes, and they'll have some affordability and potentially some reliability challenge. Like we were seeing in New England, they're worried about not having natural gas this summer, and that's in part a consequence of very difficult permitting for natural gas pipelines. So there's some control there. Now, in your second question on the fairness of where we'll be paying more than our fair share. And I attempted to address this earlier. So I think that is something we'll have to watch. I actually think Kansas having abundant wind resources in particular has been a benefit to Kansas. Like with any industrial production, there are a lot of farmers and others who are reaping the benefits of having royalties associated with the production, and that a lot of those wind farms are serving adjacent states, but it's being funded by outside capital, and it's construction jobs that are driven here. I do think that with involvement in SPP, with engagement by our company, with engagement by the commission, we can make sure that the things are allocated fairly. I think we'll want to watch Western expansion to make sure that it's all well and good, but we want to focus on making sure that the balance is struck in our area. I think that we can. I think that our focus will in particular be on the allocation of the impacts of congestion across all of our customers. Right now, it can impact those in the Far East more than it does in the West. Some of those are benefiting from congestion because they're getting bottled up low-cost wind. So I think we can strike a balance over time. And ultimately, the fact that we have abundant wind resources and good solar will inure to the benefit of Kansas, because we'll get a lot of resources built here, and that'll help lead to green ammonia, green hydrogen, and other production here that we wouldn't otherwise have. But we are going to have to stay involved and engage in SPP because it's immensely complicated, especially in the transmission planning side. And we want to make sure that we take advantage of the seat at the table that we have. I don't think that's too Pollyannish. Maybe time will tell, though, and I know you'll hold our feet to the fire.
Well, I appreciate the granularity of your response. That's very good. I think it's interesting that notwithstanding all of these deadlines that many states have self-imposed upon themselves to reach the zero emissions levels, that this is the EIA. This is recently that while renewables may be the fastest growing energy source in the U.S. over the next 3 decades, petroleum and natural gas will remain the most consumed energy sources in America through 2050. There you go.
An advantage of, a consequence, I shouldn't say an advantage, but there's much more attentiveness and attention to potential reliability issues now than there was 2-3 years ago. I mean, and it's very unfortunate that there were some devastating consequences for Uri, especially in Texas, but even in our area. But between Uri and some of the alerts and alarms in other regions of the country going into last summer, and some awareness even into this winter, there's much more attentiveness, I think, nationally to reliability issues than there was even a couple of years ago when there was, there maybe wasn't enough attention to it, but there's more now. There's no question.
Very good. Thank you very much. That concludes my questions. Steve and Bruce, thank you so much for your input here today. It's been very valuable for us. Thank you as well, David and Kayla, for your help in responding to those questions I asked. All right. I'm going to guess, David, that Chuck's up next.
Chuck is up next, and I'll close it out. So Chuck, take it away.
All right, I'm going to go ahead and start while Cody's pulling up the slides, and I'll start on slide 56. So good afternoon. I have the dubious distinction of being the last one running the anchor leg here, and so I'll try and be efficient. But we're also talking about one of the smaller areas of investment under our capital plan, but it's certainly not the least important. You know, as I reflect over all the comments and the interactions today, Chair Keen, you mentioned your interest in reliability and resiliency. We had a great discussion with Commissioner Duffy on the importance of the IIJA and other partnerships with the federal government and how we could leverage that. And then just most recently, Commissioner French talked about the grid of the future. And the truth of the matter is that technology investments, while relatively small compared to the rest of the investments we're making, are what enables these capabilities and leverages the investments that we're already making to bring more value to our customers. So whether it's grid enhancements that we just talked about that enable technology versus wire solutions, could be something like localized distributed generation or demand response, whether it's cameras for security, whether it's voltage optimization, fully utilizing the automated sensors, monitoring and switches that we're deploying on the grid, or ultimately getting to something like bi-directional flow on the grid. Technology investments make all of that possible. And they also allow us to focus on efficiency and cost savings, which is a big benefit that technology brings, as well as a wealth of customer service and customer experience improvements. So I'd like to talk a little bit more about those things today. First, I'd like to note, as you look at page 56 or slide 56 rather, I'd like to note that our 5-year forward-looking capital investment plan for technology investments has actually decreased since 2021 by about $13 million. The most significant reason for this is that immediately prior to the merger of Westar and KCP&L, and really through the end of 2021, we completed a significant amount of technology investment in simply replacing very old, outdated core systems and then consolidating onto one unified technology platform as a combined company. So now that those core system replacements are mostly completed, the pace of our capital spend on technology has slowed some. Go ahead to slide 57. As a brief refresher, replacing our core operations and customer systems was a large multi-year project, really not unlike building a power plant in scope, with more than 200 people working on it over a 5-year period. And during that time period, we replaced and upgraded more than 24 core systems that touched billing, metering, outage management, grid operations, our entire telephone and communication system, and really every single aspect of our call centers and our customer service operation. The core systems were replaced. And these investments gave us a really strong foundation for unlocking a significant amount of the cost savings and efficiencies that David spoke of earlier that we have achieved since the merger and that we are actively passing on to customers. They also provided us a platform to make future investments that will enable just the things that we've been talking about today: grid automation, more reliable overall operations, improved analytics to offer a better customer experience and a better cost profile. All of these things and down to how we integrate and operate and service customers are the future investments that we are talking about when we talk about this next 5 years. And then finally, and something that we should mention on, particularly given the conversation about security with substations, these investments have significantly improved our cybersecurity profile to a level that is now benchmarking at the very top of the utility industry. And while these investments provide a lot of value, technology is a little bit different from the more typical utility investments that we've been discussing today. When you upgrade a substation or a distribution or transmission line, these are investments that have a useful life that is measured in decades. The same is not true for technology investments. Their lifespans are much shorter, really closer to 5 or 10 years at the most. Their very nature means that they are being updated and patched for security and new features all the time. Just think about your mobile phone and how many times when you look at it in the morning, there's an app on there that needs to be updated. That's the same kind of thing that we deal with when we're talking about technology. And then finally, just the pace of change with technology. It changes and improves a lot quicker than some of our traditional utility investments. So I'll go to slide 58 now. There are really 3 categories that we think about when we think about our technology investment. One is our core systems. We just discussed that. That drives efficiency, it drives security, and it's a platform to improve operations and customer service. The second is communications infrastructure. Earlier today, Bruce and Steve talked about upgrades to our transmission and distribution system. As we replace and improve that infrastructure, we're adding, as we've discussed, a lot more automation and a lot more security. And as it becomes more automated, we actually, and that helps, improve reliability, restoration times, but it also requires a much more robust communication system to handle the data and the communication with all those devices over hundreds and thousands of miles. And so almost 30% of our technology investment over the next 5 years will be to build a private LTE cellular network and to expand, replace, and improve the capacity of our fiber optic network, which really enables all of this grid automation and resiliency through the data it requires and generates. And then the third category of investments is in software that really improves customer service and experience. And I'd like to talk a little bit about that with this slide. So as you can see on slide 58, the green areas are those investments we already made and are in our core systems and core capabilities. Replacing our core systems allowed us to improve our website, enable more customer self-service through online electronic accounts, offer a new outage map, new notification services for outages and restoration for customers. And this year, we added a mobile app, a consolidated Evergy mobile app to the portfolio of things that customers have access to as well. And again, that's all in green. But one example of what the future looks like, and I'd like to highlight a little bit, is just a project we're currently working on with a company called Uplight. Uplight is a company out of Boulder, Colorado, that currently does business with around 80 utilities across the United States and Canada. And this investment is depicted in blue on this slide. For Evergy, Uplight is really providing 2 key services. First is their Uplight Connect platform. Now, this is software that essentially takes all the different core systems that we installed and provides a unified and standard interface for a more secure and rapid customer-facing technology investments we make in the future. In other words, Uplight Connect is like your computer's operating system. It's like Microsoft Windows or Apple iOS. By having one operating system that interfaces with everything that interacts with customers, we can provide additional customer services and features that are more integrated with each other, they're more secure, and can be developed and launched more quickly. It also helps us eliminate the cost of integrating that new software with all of our core systems, again, by standardizing and streamlining that process. Second, Uplight is going to provide us with a suite of enhanced customer solutions, things that our customers don't have access to now, but through dialogue with them and whether they're business customers or residential customers, we know that they would like to do. For example, and you can see these here in blue, they include things like Rate modeling, that's increasingly important for customers, knowing with different rate options out there and with different types of customers, whether you're an EV customer, whether you're a distributed generation customer, whether you're a customer from a business perspective that has load that you can shift in periods of high demand. Being able to model rates, being able to understand demand management, and then get personalized communication with the company. Those are all things that this first generation of uplight projects will begin to unlock for our customers. Then finally, on slide 59, ultimately, our goal is to provide our customers with the ability to interact with the grid and with us from a customer service perspective seamlessly, regardless how they do it or what technology they have in their own homes and businesses. Just 20 years ago, customers interacted with their utility primarily by mail and phone. And now customers expect to be able to transact business and communicate with customers, or excuse me, with the company, and to be able to do it through a multiple of channels, but also be able to shape their demand and shape their use profile and do it in an automated and efficient way. This is an omni-channel approach. It's an omni-channel world, and that is our goal, to provide a personalized customer experience while continuing to drive out cost of our processes for our customers. So that's just a brief snapshot of the what and the why of our technology investment. I'll be happy to answer any questions at the appropriate time, but for now, I'll turn it back over to David to conclude on the last slide of the section.
Thank you, Chuck. So the 2 more slides. Thanks again for your patience with us. So the section takeaways, again, we know how important it was in this workshop, and hopefully we've been able to discuss the changes in our plan versus the 2021 plan that we filed, and the drivers for the choices that we made, the benefits it provides. Key takeaways first: renewables and inflation impacts are the primary drivers for higher 2026 when you compare that annual plan with 2021. Second, 80% of the increase in investment between 2022 and the 2025 time period is driven by our updated resource plan, which Kayla went over, focused on achieving the lowest long-term cost for customers. And the second component of the increase being increased distribution system investment. Third, in evaluating new generation investments, in particular, that portion of our plan, we will continue to evaluate ownership versus PPAs, power purchase agreements, through a detailed sourcing process that considers the total benefits to customers, both direct and indirect. Fourth, distribution and transmission investments are focused on enabling an aging grid to meet increasing customer demands. So distribution investments, as Bruce covered, prioritize resiliency and replacing aging equipment in order to ensure robust infrastructure and public safety, enable more efficient operations and reduce outages. And as Steve described, planned transmission investment, even at the levels we have now, does not keep up with aging in several key asset types. And therefore, as we prioritize, we take a risk-based approach in picking those projects that ultimately drive the biggest benefit for customers. And finally, as Chuck summarized, planned technology and customer investments have declined slightly, plan versus plan. Still a sizable investment, important area of investment as they focus on improving infrastructure, lowering costs, and delivering overall an enhanced customer experience. So if I go to the last page in our document, overall summary, again, as we think about our capital investment plan, how we think about where we're prioritizing our infrastructure investments, our goal is to advance and balance affordability, reliability, and sustainability for the benefit of our customers. We've been able to improve regional rate competitiveness since Evergy's formation in 2018, and we expect to continue that progress due to our ongoing focus on efficiency, a lower rate of investment relative to peers, and a balanced generation mix. As I just covered, 80% of the growth in the capital plan is focused in 2 areas: new generation and distribution. And then lastly, in reflection of our planning process and how it's always moving forward, we'll file our 2023 capital investment plan in February, so only a couple months from now. And we'll have an important update to our integrated resource plan in the second quarter, mid part of 2023, given the IRA as a new input, as well as some differences in the marketplace as well, especially commodity costs. So with that, thank you again for your time, for your patience with us as we went through 62 pages of material. We really appreciate the opportunity to review our capital investment plan and the benefits that we believe it will deliver for our customers. And I will turn it back to you, to Chair Keen, for our last segment of questions.
Thank you very much, David. And that's what we will do. We'll go back through one more time here and see if there are any questions. I don't believe, I don't have, beyond that, I don't have any questions that would take us into a confidential section. So if any of you have that, you might let us know if you've saved those, but I have none. Let's go for this final round of questions. I'll begin first with our KCC staff and start with Jeff McClanahan.
Thank you, Chair Keen. I don't have any questions on this section. Justin, how about you?
Nope, me either. And I don't have any questions for a confidential session. We have that modeling, that detailed rate modeling, and I pretty well asked my questions earlier in the public session, so I'm good. Thank you.
Leo,
right.
You have any questions?
I do not. I'm good.
Well, thank you, David and team. We very much appreciate your presentation today and all the information we gathered. So much appreciated.
Thank you very much for all the engagement and discussion. I know we'll have some follow-ups, I'm sure.
I'll turn next to Curb. Joseph, any questions?
Thank you, Chair Keen. At this time, I have no further questions, and I've asked all my questions through the public portion, so I don't have any questions related to competency either. I'd like to, on behalf of Curb, extend my gratitude as well as the Curb staff to allow us to review this documents and be part of the IRP and capital investment plan process. And thank you for your time today.
Thank you.
Very good. Let's see, any follow-up commissioner questions or comments? Commissioner Duffy?
Yes, thank you, Chair Keen. I want to go back to a comment that Chuck Casely that you made, not in this section, but a previous one, that the public's demand for reliability is probably more than it ever has been. In the past, you're right. The lights go out and during the day, it's just keep the refrigerator closed, don't open the door. And at night, get the flashlights and whatever out. Not that big a deal. You don't get to watch I Love Lucy. Now we're all connected and depend on it for our entertainment, our work, a variety of things. But I will tell you that in reading through this section and in your plan about the IT technology as it relates to facing with the customer, I just felt that it was a lot of overkill. I don't want a customer experience with Evergy. I want my lights to be on. I appreciate hearing that, oh, yes, we know your lights are out and we think they'll be on in 3 hours. And that's been helpful several times over the last year. I don't think anybody, even if you're passionate about your energy consumption, you're sitting there like it's Zelda or whatever the games are that everybody's playing. I just don't think that sort of experience, user experience, is important. Yeah, your usage, yeah, but most people just want to pay their bill. And if it's hot and they know the air conditioner's been running, they'll go flip it up to 75 or whatever. And I just hope we don't use our resources to the extent, 80 utilities using this Boulder firm. I hope we keep it to maybe what is really necessary. I hearken back to your comments, keeping the lights on. And as Commissioner French said, the bulk of the dollars is in transmission and distribution. and I agree. But I also believe that's the more reliability, resilience part of this. And anything that we can do to bolster resources going there. And I do like your comment, Commissioner French, about thinking outside the box and instead of just replace, but thinking strategically, how can we best do this? That would be my only comment, Chuck. The bells and whistles don't fascinate me. Maybe I'm part of the older generation heading out the door, but I don't see my kids on their phone looking to analyze their utility bill.
Yeah, no, it might surprise you, Commissioner Duffy, that I also am getting to the older side of the generation. I don't disagree with you. In fact, I think it's important for us to talk about, the ways customers interact with us. But that is certainly not the focus here. So if you think about the technology investments, the first thing I talked about was the communications infrastructure. That's a technology investment. It's about 30% of what we're talking about here. That enables a lot of those things that Commissioner French was talking about. That certainly isn't how customers interact with us. That's reliability. That's cost effectiveness. I also think that, when we look at these things, some of the first things we look at are compliance and security. So for example, compliance, FERC 2222, as I know the commission is well aware, is going to create a lot of different requirements for us to be able to give access both to customers and to third parties from a technology perspective. So we think first there, then obviously security, that's very important. And then finally, anything we do from a customer interface perspective, I think has to be one of two things. Well, two things really. One, it has to be something that is relatively small, incremental, and leveraging the technology we have to do. And the second thing is that we have to run a cost benefit analysis and say, if we make this investment, then in the long haul, not only will we get better customer service, but it also has some other tangible value. So I'll just give you one example, and that is the outage notifications that you talked about. That's very convenient to you. That is something that makes it so you don't have to pick up the phone and call us, which costs money. And you don't call us multiple times, which frequently costs a significant amount of money. It's not a great experience for you because every time you're calling, it's because you're frustrated and you don't know what's going on. And so by doing that, we can drive calls out of the call center, and it's a better customer service for you. Ultimately, I agree with you. And again, from the chief customer officer, this may be surprising. Bells and whistles, as you called it, for the sake of bells and whistles, that's not what we're going for. But if we can leverage some of the investments that we're making for real grid solutions to ultimately really benefit customers that are increasingly in different positions, for example, folks that might have distributed generation, or folks that might have demand response programs, or folks that might have EVs, to the extent that we can use a better customer experience to drive cost out of the system or enable something good from a grid perspective, that's where we're going to focus. Just being able to get a greater percent of your mind share on your mobile phone, that's not what we want. And I wholeheartedly agree with you.
Thank you. I appreciate that. I will say this, Chair Keen, I believe this experience has been really beneficial. I do think workshops are valuable. Yes, they do take up a lot of time. But to be able, whether we're in person or in Zoom, which I think then the public really gets to hear and better understand, I think is an invaluable experience. And as we look at whether it's this plan we're discussing or a variety of other things that are on our horizon collectively, I do think this is a good experience. And allows for a dialogue that has been beneficial to me. So I appreciate everyone's time today that put together the material to enhance what we already had and then shared with us. And staff, thank you too for your continued diligence in helping us better understand issues.
Thank you, Commissioner Duffy. Commissioner French?
Thanks. I don't have a question, but I do have a comment, and you may have seen me smiling. It's awkward. It's almost the exact opposite of what Commissioner Duffy said, but that's okay. It tells everybody we're not a monolith, and we have the Kansas Open Records Act, and we don't talk, we don't coordinate. So, I mean, I'm my perspective, I think customer experience is going to become more and more important in the future. And I'm not saying that I think you can reconcile Commissioner Duffy's views and mine. I think it is going to become more important. I think people are going to want more and more control as they have more devices reliant on the grid. They're going to want more flexibility. They're going to want more rate options. They're going to want to talk to the company about what their options are. But those are, I think the point though is well taken that you can implement these things with small dollars. I mean, in the grand scheme of a capital intensive company like Evergy, these are not large investments. Please don't become a social media company. Don't go buy Twitter. Although you might be able to get it for a really good price.
It's a pretty good price right now, I think.
But maybe it's where I am and some of the technologies that I rely on. But I personally would like to see more options, more availability of flexible rate options or things that give me more control over my bill. So like I said, I think that can be reconciled. I wouldn't view those things as bells and whistles. I view them as things people can use. So that is my only comment, though. Not really a question, but I do appreciate all the information and just knowing where you all stand. And I think you have shown, you've stepped back your investment in these areas a little bit, keeping things within reason. And I think that's prudent. So thank you.
Well, and Commissioner, I do think that it's pretty easily reconciled. Again, I think if we just prioritize the things that provide grid value, provide security, and are useful on their own, but also may have some additional or tangential benefit of providing customers better interaction. I think before we get to anything that I think Commissioner Duffy would truly consider was a bells and whistles, there's a lot of things we can do for a reasonable price that add value to the grid and that personalize things for customers, so that you can interact with us the way you want to, and Commissioner Duffy can interact with us the way she wants to.
Well, thank you. Right. And let me just say, once again, just echo Commissioner Duffy's comments that I really appreciate the time. And it is clear that you all have prioritized giving us your time and giving information and allowing us all to participate in this. So thank you.
Thank you, Commissioner French. My provincial bias tells me the customers want what we want. They want affordability, they want reliability, and they want resilience. And it isn't too much more complicated than that. More difficult to deliver than it is to enunciate. David, thanks so much to you and the entire group at Evergy for providing us with your time here and your thoughts. It's been a very beneficial experience, I think, for all. And is there any final comments you'd like to make? I'll give you the last word.
Well, Chair Keen and Commissioner French, Commissioner Duffy, I just want to say thank you again, and to staff and to Joe and Curb. And we really appreciate the opportunity today to go through our plan in detail. We appreciate your taking a full day out of your time to allow us to go through that. We are focused in trying to drive a plan that strikes right balance and ensures affordability and reliability and advances a sustainable grid, reliable grid, a resilient grid, and a responsible transition. Thanks to my colleagues for helping to put this material together. Nothing more important to us than this kind of interaction with our regulators and our key stakeholders. So thank you again for the time today, and best wishes to everyone for a safe holiday season.
Thank you. And we want to thank also our IT staff for enabling this event to be provided. We overcame a few minor hurdles, but in all, it worked out very well. So we thank our IT staff, and thank all of those of you who participated in this. We had a fair number of participants here who were listening in. Thank you so much for spending your day with us. At this time, we're going to bid this sine die. This concludes our work study. We are now adjourned. Take care.